A very good evening, friends. So I hope you're all preparing well for the exams. I think since the start of the February, the countdown almost begins that, the lesser time gets there. And I hope your preparation is on a good swing. And I hope you've also done a comprehensive revision on financial instruments. And today is the last day when we're going to wind up the huge topic, interesting, complex, of course, but very interesting topic on financial instruments. Now, I've got two agendas for the day. One is that we need to cover up the aspect of impairment of financial assets. And the other is the concept of the discussion on embedded derivative, where a company enters into contracts which are hybrid in nature. That means they are containing a non-derivative as well as a derivative component, and they're called as hybrid contracts. Then how does the accounting in terms of the derivative, which is embedded in the instrument, done? So these are the two focus areas. I guess I'm going to start with the concept of impairments with you, which is a little technical one. And I think it's a very interesting agenda, though I think if you look at from a practical point of view, impairment testing has got its own huge level of challenges. But of course, that kind of challenges, of course, you're not going to face in the examination environment. But I think I'll still like to give you a little good insight on the concept of impairment testing. You must understand the concept of ECL. That is what is called expected credit loss model. So I think let's begin the journey. Let's first talk on the concept of impairment of financial assets. So let's give you some inputs to begin with. So once again, good evening to all of you. So I think let's begin the journey. Well, I'm looking in terms of the concept called impairment of financial assets. We're looking at impairment of financial assets with reference to Ind AS 109. I'm sure as you hear the term impairment, what comes to your mind is we've done impairment earlier as well, and we have done Ind AS 36, which talks of impairment of assets. So which assets are covered under the impairment of 36 and which impairments are covered under 109? I think we'll talk of that. But first, let me tell you, with reference to financial assets, what is the concept of impairment? Well, if we can say that if I were to be, putting across a simple question, what do you mean by impairment of financial assets? I would say, for example, if you look at a banking sector, they would give huge loans and advances to the public at large, or maybe to the corporate companies. And if there has been a default or there is an expected default, it means a case of a non-payment. It means a case of a non-recovery. That means there is a default and the contractually agreed cash flows are not being received. So impairment would basically mean, I would say, an expected, I'm intentionally using the word an expected non-recovery. I'm using the word expected because, of course, I'll tell you why I'm using that word. So it is called an expected non-recovery. You've entered into a contract, you're getting some contractual rights to receive, and you may not receive those contractual rights of cash flow. It would lead to a non-recovery of the money. Now, let me first tell you one thing. As we're all aware that, when you create a provision for doubtful debts, it is nothing but impairment. Like, for example, in the intermediate, you used to create a provision in terms of all those standard, substandard, basically that provisions for non-performing assets. That was also nothing, but it is impairment. Now, when a company goes in for impairment, we can say that there are two kinds of models which are available in terms of booking this impairment. I would say there are two kinds of models which are available in terms of booking this impairment. One is called an incurred loss model. One is called an incurred loss model, and the other is called an expected. The other one is called an expected credit loss model. So we call it in short as ECL, that is expected credit loss model. So let's first understand a little distinction between what is an incurred loss model and what is supposed to be an expected credit loss model. Well, I guess as the name is suggestive, when you're looking at an incurred loss model, you're saying that I have already incurred a loss. Let's say, for example, my debtor is not paid me the money. Like, for example, if I've given a loan to a client, he is defaulted, already defaulted in terms of making the interest payment, or he is already defaulted in terms of making a principal repayment. So as the name goes, incurred loss model, it means the loss is already incurred. Ind-AS 109 does not use the concept of incurred loss model. I would say in terms of IGAP, when we were looking at the era of accounting standards, we were making a provisions on the basis of incurred loss model. Your debtor is not paying you money, the money is overdue, and you've already incurred a loss. And that's the time when you say, okay, I'm doubtful of recovery because he's not paid the interest and I'm doubtful of recovery. So you start creating a provision based on an incurred loss model. Ind-AS 109 makes it very clear that when you're creating a provision for non-recovery, that is an impairment, you need to apply the concept of what we call an expected credit loss model. Now, let's understand this in detail. I'm not assuming any base on your background in terms of what is ECL. We're going to understand this on a step-by-step approach. There may be, in between certain phases where you'll say, oh, what is this? But don't get worried. I think in the next almost around half an hour, you'll start getting a grip in terms of impairment testing. Now, if I look at the word ECL, the word which is used is expected, that is one. The word which is used is credit loss. The word used is expected credit loss. So there are two words when I say ECL, that is expected credit loss. Now, I would say there are two terms. One is what we call a credit risk. And now hear this very carefully. So one is what we call a credit risk, and the other is what we call a credit loss. And there is a third term which is called an expected credit loss. Trust me, these are three different terms. I'm saying what is going at the back of my mind is a total of three terms. When I look at the ECL, that is expected credit loss model, what comes to my mind is a total of three terminology. The first term which comes to my mind is what we call, the term number one is a credit risk. I'm using the word a credit risk. The term number two which comes to the mind is what we call a credit loss. What we call a credit loss. And the third term is what comes to the mind is an expected credit loss. Let's call it as ECL in short, that is expected credit loss. Now, I'll first explain these terms so we can understand what is the concept of an ECL model, that is an expected credit loss model. Now, let's assume that my company is given a loan to certain clients. Can I say if I have given money to the certain clients, I am still running a risk, and the risk is that they may not pay the money back, or they may make a delay in terms of payments. They might give me the money, but they may not give me the money on the contractually agreed dates. Remember, I'm talking of two things. So I'm looking at a credit risk, which is a failure to pay. So when I say that there is a credit risk, the credit risk means that I am facing the risk of failure to pay by the other party. So for example, if I'm looking at that I gave a loan to certain clients, the moment I gave a loan to the clients, I'm definitely suffering, I'm definitely facing a credit risk. The credit risk is that I gave them a credit. And when I gave them a credit, I'm running a risk of, not getting the payments. So when I say a credit risk, it is a failure to pay by other party. So if it is a failure to pay by the other party, there is a credit risk. Now, this credit risk can lead to a credit loss to me. So when I'm given a loan to someone, I am facing a credit risk, and this credit risk will lead to. So I would say the credit risk would lead to a credit loss. Now the question rises, what is a credit loss? Well, in simple words, if you look at the definition and the standard, it gives a little technical input. But before I take you to the technical inputs, let's put it like this. A credit loss can be in terms of two things. One is that there is a non-payment. There is a non-payment. That means a credit loss. I'm not able to recover the entire contractual receipts. I had told him that this is the loan you are contractually obliged to give me. So I've got a contractual right to receive the money, and I do not receive the contractual payments. It is a non-payment, or I can say there could be a delayed payment as well. There could be a delayed payment as well. I think let's first also look at a delayed payment, because we all understand a non-payment, but let's understand what is a delayed payment. Let's consider that I am considering contractually, I was supposed to receive, let's say over the next 3 years, a total of, let's say 1 lakh, then another 1 lakh, and then I'm supposed to receive 10 lakh plus another 1 lakh of interest. So this is what I'm supposed to receive on a contractual levels. I'm contractually obliged, contractually due to receive 1 lakh at the end of first year, second year, third year, and 10 lakhs at the end of third year. Now, let's say this fellow paid me 80,000 in the first year, then he paid me 1.2 lakhs in the second year, and then he paid me another 11 lakhs in the third year. Now, I would say that there is been no non-payment. There has been no non-payment, because if you notice, the total money which I should have received is to the extent of 13, and I did receive 13. So it's not a case of a non-recovery, but it is a case of a delayed payment. And if you apply the concept of time value of money, if you apply the concept of time value money, I am definitely having a credit loss. So you can say that when a company puts in the money in financial assets, let's take loans and advances, let's take debtors for that matter. So in these particular cases, we can say the moment my company has given loans and advances to the clients, let's say as a banking sector, I am definitely facing a credit risk. Now, this credit risk, mind you, you might say, sir, I've given a loan to parties or very safe parties. Well, the credit risk might be less, the credit risk might be greater, but there is definitely a credit risk. Like, for example, if I am crossing a road, now, if I'm going to cross a road and I look at the other side and this side of the road, there is no traffic, but still there is a risk. Let's say out of the blue, something happens. So I cannot say that there is no risk at all. I can say, yes, the risk is less, or I can say the risk is high, but there is always a presence of a credit risk. So the moment you give loans, the moment you've got debtors, so one thing is very clear, that every company which is got loans and advances, which has got financial assets, is definitely exposed. You can say you are definitely exposed to a credit risk, and this credit risk will lead you to a credit loss maybe. So in this particular case, the standard says when you're looking at a credit loss, it means either you do not get what you're contractually, got a right to receive. So let's say in this particular example, I don't get this entire amount of 13 lakhs. I'm contractually, I've got a right to receive 13, but I don't receive the entire money back. So there is a credit loss. And even if I get the 13 lakhs back, but there is a delayed payment, and due to time value money, I'm going to suffer. So I hope you've got what is a credit risk and you've got what is a credit loss. Now, what does the standard ask me to do? The standard says that when you're going to create a provision, you are going to create a provision, you need to create a provision for the expected credit loss. So you need to sit down today and try to visualize that, okay, what is the expectations that how much money I'm going to lose? How much is going to be the shortfall in terms of what I'm contractually entitled and the actual collections which might take place? So the focus is on the word that they're looking at expected. They're looking at expected credit loss. To give you very simple inputs at this stage, though we'll expand later. So you can say that this is going to involve some kind of a forecasting, what we can technically call a forward looking. I'll give you a very basic example at this stage to understand what is an expected credit loss. Because I don't want to give you the formula right now, that might be too dangerous at this stage. So let's give you something. So what the company is going to do, number one, it will calculate what we can say is a historical rate. It will calculate the historical rates in terms of default. So I have a certain loans and advances which I've given to my clients, and I will look into, you can say, the past performance. And with the help of the past performance, I will be able to get, okay, that, looking at the past, this is the historical rates of default. So let's say if I consider my debtors, I know that this is the percentage of money which generally goes bad and I'm not able to collect the money. Now, this is, you can say, is a past performance. So what I need to do, I need to convert this historical rate into, you can say, an expected rate. You need to convert this into an expected rate of default. And this involves, you can say, what we technically call a forward looking. The standard says you do one thing, you look at your past performance, get the historical data, that what is the historical rates of default, and then you need to go in for a forward looking and you need to calculate an expected rate. Now, when you're going to look at the expected rate, you're looking at a forward rate. I might look into a lot of factors, maybe the macro factors in the economy and maybe the micro factors affecting my business. For example, if the situation was of COVID, for example, then in those particular cases, I would say that, generally, if I look at the historical rates, they were non-COVID based. And if I'm looking at that, we are going through the phase of COVID, for example, naturally, the historical rates which were there, you might expect, a default much larger than that. Because people may not be able to pay on time, people may default more than the usual. So the expected rates would take into account certain factors, the micro and the macro factors. But in any case, from the examination point of view, you need not bother in terms of how the historical rate is going to be converted into an expected default rate. Now, once the company is getting an expected rate, practically what is done, just to give you a little practical feel in terms of how things is done, the standard requires you to calculate this expectations based on at least a 3 scenario. So look at the situation that, let's say I'm going to consider a best case scenario. Let's say I'm going to consider a most likely scenario. Let's say I'm going to consider a worst case scenario. So I would basically sit down and create certain scenarios, at least a total of 3 scenarios, looking at the expectations of defaults based on a best case, based on a worst case, and based on a most likely scenario. And let's say, for example, your historical rates were, let's say, 5%. I say in a best case scenario, maybe the defaults might be 4. In a worst case scenario, maybe the defaults might be 7. And let's say in a most likely scenario, let's say the default is going to be 6. So you would fit into different scenarios and then each scenarios would be given a weight. And generally we don't give a weight which is 50% to a given scenario. The weight attributed to each scenario would be kept definitely below 50, but not equal. So let's say I consider a 40% to the best case, 40% to the worst case, and let's say a 20% weights are assigned, and these will be assigned on the basis of judgments. So we would say that, okay, let me consider a weight assigned to each scenario. So I'm expecting a 40% a best case scenario, a 40% worst case, and a 20% which is a most likely scenario. And I would basically consider what you can call it as, in simple words, as a weighted average. And this weighted average is nothing but, you can say, an expected rate. And that is the reason the standard says that you need to look into an expected credit loss. The word expected is meaning that you're looking at a weighted average of certain possible outcomes. So in this particular case, when you've taken different scenarios and you've taken a weights in terms of each scenario, you are getting an expected, which is a weighted average credit loss, which is based on the forecasting, which is based on what is expected is going to happen. So the expectations is not only with reference to future, the expectations is also with reference to the fact that you're going to take a weighted average expectations. So this is how the things are technically done. So I'll just quickly consolidate. I hope you've got the entire picture in terms of what is an ECL. Okay, Tariq, you said, so is there any relationship between ECL and NPA? Well, if you look at the banking sector, the concept of creating a provisions on NPA is based on a incurred loss model. In terms of intermediate, when you calculated the provisions for NPA, we used to classify the advances according to certain parameters as standard, substandard, doubtful, and a lost assets. And then, a certain fixed percentages which are prescribed by the RBI used to be applied on those particular assets, and we used to create a provision based on that. There was hardly any kind of, you can say, a forward-looking or even a past, backward-looking things. You were basically looking at the historical information, that what is the level of doubtfulness, how many days the money is being overdue. So there was nothing which we were doing in terms of forecasting. So I would say creating a provisions on NPA is something which is called an incurred loss model. And moving forward, when the banking industry is going to apply Ind AS, though they do not apply Ind AS as of today, but once they go to apply Ind AS, the same provisionings for NPA, which is based on those rule-based percentages, is going to be taken over by this particular concept. So the banking industry would also start looking into creating a provisions for loans and advances, that is creating a provisions for NPA based on, you can say, an ECL modeling. I hope you got here the inputs. The connect in terms of ECL, ECL is creating a provisions on NPAs with a forecasting technique. Okay, and Jyoti sir, if you got collateral against a loan, but now value of the collateral decreases, how do we treat that in such a case? Too early to answer that, but you'll definitely get your answer in some time, in half an hour's time. How do we tackle that? I'll be coming to that as well, because I'm going to now take you to the inputs in terms of a three-step model which I've created in terms of creating provisions for impairment. So you'll very definitely get your answer in some time on that. And the bunches of probabilities are taken to calculate expected rate. Absolutely correct, right? Let me just, I think, quickly consolidate the learnings and then take it further. Trust me, you will get a good hang on the concept of ECL model. You'll start understanding it conceptually. Little more than the exams, but of course not to the levels of the practical world, because things can be much, much more in magnitude in terms of the practical life scenario. Okay, so I introduced you to the concept of impairment, and I said, let's first understand three inputs. One is, I said, is a credit risk. Then I said is the word credit loss, and then is the word, you can say, expected credit loss. So in this particular case, just to give you a quick brief, I can say that if I'm looking at typically loans and advances, they're financial assets for me. I'm looking at debtors, I'm looking at lease receivables. So all these things, your debtors, your lease receivables, you can say loans and advances, all these are financial assets. And the company is facing a credit risk. And the credit risk is that the other party might default. So when I say a credit risk, it means that I'm running a risk that when I park my money into the financial assets, I'm definitely exposed to the risk, and that is called the failure to pay by the other party. So when I'm exposed to a credit risk, this credit risk, that is the possibility the other person may not pay money, exposes me and leads me to the fact that I might incur a credit loss. Now, I think let me also put this technically what the standard says. The standard says that the credit loss in technical words is called the present value of cash shortfalls. It is called as the present value of cash shortfalls. We'll take an example to understand this later. But we can say the credit loss is supposed to be the present value of the cash shortfalls. Well, if somebody would say that what is a cash shortfall, I would say do one thing. Make a list of what you're contractually entitled to receive as per the dates, and see what is the expectations when you will receive this money. Are you going to receive this money on the same dates, maybe a lesser money, or maybe on a delayed level? So what you're contractually, entitled to receive and what you will actually receive, take the difference. The difference is called a cash shortfall. The present value of that cash shortfall is supposed to be, you can say, a credit loss. So when I'm saying a credit loss is a present value of a cash shortfall, it basically means that my credit loss can be on account of two reasons. The credit loss could be on account of reason number one, the person doesn't pay my money. So that means I'm contractually entitled to receive an X amount and I don't get that X amount. That is one. I get lesser than X, so there is a shortfall, and the present value of shortfall is the credit loss. Or the person pays me what am I entitled to, but there is a difference in terms of when he pays. So sometimes he pays me more, there is a cash excess. Like in this case, you can say in the first year, there is a shortfall of 20. In the second year, there is a cash excess. But due to the delayed payment also, because of the time value of money, I am also going to suffer a credit loss. So remember, the credit loss is not only the other person doesn't pay you the money, but the credit loss is also he pays you, but he delays the payment, and due to which, on account of time value money, you're going to lose and there is a credit loss. So are we going to make a provision for that expected credit loss, which means I get everything, but I get delayed? Yes. And then we came to the concept of what is an expected credit loss, where we said when you're looking at an expected credit loss, you need to basically get a weighted average credit loss. So you're going to do a forecasting, get your historical rates based on the past experience, and then make a projections based on the macro factors, and you're going to get an expected rate. Run this expected rate based on three kinds of scenarios at least, get a weighted average of the expectations, and that's called the expected credit loss. So far, so good. I hope I am pretty clear on the concept so far. Okay, wonderful indeed. Now, let's take it further, and we're now going to understand how the provisioning in terms of the ECL model is made. So I'm going to give you a simple three-step model. Though the standard does not talk of this three-step model, but I'm going to give you a three-step model in order to understand how the impairment provisionings is done. Let's begin. So at the step number one, what I'm going to do, I'm going to first of all see that is the asset within the scope of the standard or not. Now, please hear me carefully, because the next half an hour is going to be very crucial. If not half an hour, at least 20 minutes or so is going to be very crucial. I'll do a lot of questions to support this as well. But just see the concept very carefully, how the provisioning is done based on this three-step. So the first thing I'm going to do, I'm going to look at the scope of the standard, and I would say there are basically two kinds of assets. One is what we call is non-financial assets. So I would say there are two kinds of assets. One is called a non-financial assets, and the other is called a financial asset. Now at this stage, per se, if somebody were to ask me that which standard applies, I would say per se to the non-financial assets, we got to apply impairment testing under Ind AS 36. And per se, when you're looking at financial assets, I need to apply Ind AS 109 for impairment testing. But there are certain financial assets whose impairment testing is done under 36. You heard me correct. There are certain financial assets whose impairment is done under 36. Number two, there are certain non-financial assets whose impairment testing is done under 109. So it is not technically correct to say that only financial assets are covered under 109, only non-financial assets are covered under 36. There are exceptions to both. Let me give you those exceptions as well. Now, if somebody were to say that what is the exception? What is the exception where a financial asset is covered under Ind AS 36? Now, let me remind you, when you look at investments in equity instruments, when we do equity investments, you can say the equity investments are of two types. One is related party investments and one is unrelated party investments. So when you make equity investments in a subsidiary, in a joint venture, or in an associate, they are basically related party investments, and the financial instrument standard excludes them. I think you would remember when we were started off the concept of financial instruments, I made it very clear that Ind AS 109 covers equity investments only in unrelated party when you make a passive investment, which means that when you're looking in terms of investments, I'm saying equity investments. I'm saying equity investments, they are either related party investments or they are unrelated party investments. Now, when I say it is a related party related party investments would mean the investments in a subsidiary or in a joint venture or in an associate. And when we say unrelated party, we can say that you're acting as a passive investor. Ind AS 109 is applicable to these unrelated investments. But Ind AS 109 is not applicable. Ind AS 109 is not applicable to related party investments. Rather, they are covered under Ind AS 27. Rather, they are covered under Ind AS 27. So these are covered under Ind AS 27. And as per Ind AS 27, if you remember, they are either taken at cost or they are taken at a fair value. They're either taken at a cost or they're taken at a fair value. Remember that these equity investments are either taken at FPTPL or they are taken at FPTOCI, that is NR. Get the facts very clear. So when you're looking at equity investments, when you're looking at equity investments in unrelated party, so all these investments are accounted under 109 and they're either accounted under FPTPL or FPTOCI with NR, there is no recycling. But as far as related party investments are concerned, they're all accounted under Ind AS 27 and they can be taken at cost or fair value. If you choose to apply a fair value, you're back to Ind AS 109. You're back to Ind AS 109. But if you apply the concept of cost, the impairment testing is done under 36. So this is complicated. Don't worry, I'll just consolidate that. So you can say if you've got equity investments in a related party, which are recorded at a cost model, then we can say this is going to be covered under Ind AS 36. So I think let's map up the concept in the mind. So when you're looking at the equity investments, I would say, okay, is it related or is it unrelated? If it is unrelated, I am under 109. And these are the measurement techniques. And later, I will again tell you that these equity investments are not subject to impairment testing. They are not subject to impairment testing because they're already being taken at a fair value. So unrelated party investments are covered under 109 and there is going to be no impairment testing applicable to them. But if you've got related party investments, they've been scoped out. Of the standard of 109, and in those cases, Ind AS 27 applies. And if you choose a cost model, they are financial assets. These equity investments are financial assets, but they're still considered for impairment purposes under Ind AS 36 exception. I hope, friends, I am pretty clear on the exception in this case. Okay, clear, wonderful indeed. Now let's go further. There is an exception. There is an exception which is there in terms of the financial assets as well. There is an exception which is there in terms of financial assets. Now, I don't know if you've done Indus 115 so far or not, but maybe you've got a little brief idea, or maybe you've covered that. When a company recognizes a revenue under Ind AS 115, when a company recognizes a revenue under Ind AS 115, let me just, I think, explain this a little more detail. So under Ind AS 115, when a company recognizes a revenue, under this standard, you can get basically two situations. The revenue recognition in Ind AS 115 could lead to two different kinds of situation. Number one, when you recognize a revenue, the entry which is put is account receivable debit, and the revenue gets a credit. Or sometimes when you recognize a revenue, the entry put is a contract asset gets a debit. The contract asset gets a debit, and the revenue is correspondingly given a credit. Now, the question again arises, when do you put the entry account receivable debit and when do you put the entry contract asset? Now, I would say when the revenue recognition leads to, mind the words, when the revenue recognition leads to a contractual right to receive, you create a debtor. But when the revenue recognition does not lead to a contractual right to receive, but then in this case, it creates a non-financial asset. The standard does not stop you. The standard does not stop you from recognizing a revenue, even if you may not be getting a contractual right to receive. So this account receivable is supposed to be a financial asset because it gives you a contractual right to receive, and this contract asset is supposed to be a non-financial asset because it does not give you any contractual right to receive the money. So therefore, it becomes a non-financial asset. But interestingly, the impairment testing of debtors and the contract assets both are covered under Ind AS 109. The contract asset is supposed to be a non-financial asset, but still it is covered under 109. So the exception is the contract asset. So if the company has got a contract asset, it is a non-financial asset, but impairment under 109. You've got investments in equity in a related party, financial assets, but covered under 36 applies to non-financial. So I guess now you're clear with the idea that non-financial 36, financial 109, but there are exceptions in both the standards. That there is one particular, you can say, case which is financial asset but covered under non-financial standard. There is one case which is non-financial, but it is covered under the financial standard. So once you are looking at impairment testing, you need to at the first instance be clear that am I within the scope of 109 or not? So per se, I would say financial assets and one particular non-financial asset, which is supposed to be a contract asset, is under the purview of this standard. That's one. Now, there is something more. Let's give you a little more inputs in terms of the financial assets. Now, watch this further carefully. So let's give you a little more inputs on this. When you look at a financial asset, you would recall that financial asset falls in a total of 4 kinds of categories for subsequent measurement. Either it is taken at EC, or it is taken at OCI-NR, or it is taken at OCI-R, or it is taken at FVTPL. So when you look at the financial assets, they are either at amortized cost or they are at FVT-OCI, a fair value through other comprehensive income, which is R, or it is FVT-OCI, which is NR, or it is FVTPL. So just to take the journey forward, that financial assets are covered and a one particular non-financial is covered under the scope. Now let's also see, is every financial asset going to be tested for impairment under the standard? The answer is no. So if somebody were to ask me, is the financial assets at amortized cost tested for impairment under the standard? Yes. Is an OCIR tested for impairment under the standard? Yes. Is an OCINR tested for impairment under the standard? No. Sir, OCIR is covered, but OCINR is not covered. I'll now tell you the logic. Remember, when you look at the concept of OCI no recycling, nothing ever enters the P&L. Just try to recall what you've learned in terms of OCI NR, which I have said earlier classes as well. And I said, if there is a fair value change, I'm looking at NR. If there is a fair value change, it goes in OCI. If there is a gain or loss on the sale, the derecognition, it goes to OCI. If there is any impairment testing, not applicable, because I don't want to put anything in the P&L. The concept of NR is that nothing will go to the profit and loss account. So what the standard setters decided, that in terms of equity investments, OCI NR, the fair value changes goes in OCI 1. The gain loss on sale of investment goes in OCI 2. Impairment testing not to be conducted, so nothing goes in the P&L. And even when you derecognize, the accumulated OCI directly enters in retained earnings, shifted from the tab 3 to the tab 2. Which means what? That in this particular case, they wanted to insulate the concept of OCI NR from any impacts in the P&L. So therefore, they said no impairment testing. And that's the reason I said very clearly that if you've got equity investments under 109, there is no impairment testing, and that gets covered here. Then the question rises, what about FVTPL? The answer is again a no. Because in FVTPL, the fair value changes, increase or decrease, in any case, is going to the P&L. So if you're taking the decrease automatically in the P&L, then I think the impairment is automatically taken care. So at the end of the day, you can say that effectively, which particular financial assets are tested for impairment? I would say basically debt investments. Because this is a category applicable to equity, though this is also applicable to debt equity. But once a debt is FVTPL, of course, it's not going to be applicable. So you can say, in effect, the impairment testing applies only in terms of debt investments. Any financial asset measured at AC, any financial asset at OCIR is subject to impairment testing. I hope I'm clear with the concept in terms of the scope of the standard. So what do you need to do in terms of step number 1? You need to make a walkthrough and decide, okay, is the asset in question within the scope of the standard or not? So I'm going to look at that, okay, is it a financial asset? But there is one financial asset which is not covered under the standard. 1. Okay, is there a non-financial asset covered under the standard? Yes, 2, contract. And number 3, be careful that if you're saying that they're financial assets under the standard, then AC, OCI are only. Right, friends? I guess my step number 1 is pretty much clear at this stage. Okay, now let's take the journey forward and let's go to the step number 2. So this was step number 1, deciding the scope of the standard. Now we go to the step number 2, which is a very interesting and a crucial step indeed. And now let me explain this in a little more detail. What is the step 2? Once you've zeroed down on the fact that this financial asset or non-financial asset is within the scope of the standard, now it's time to go to the step number 2 and decide the approach. So the standard has given us a total of 3 approaches. The standard has given us a total of 3 approaches which are applicable for ECL modeling. And they say the first approach is called what we call a journal approach. The second approach is what we call a simplified approach. And the third approach is what we call a POCI. This is called purchased originated. This is called purchased originated credit impaired. This is called purchased originated credit impaired. In short, we call it as POCI. I think let's keep that aside for the time being. Let's not talk in terms of purchased originated credit impaired, but just to tell you what is a purchased originated credit impaired. Let's say, for example, I am, let's say, a factoring agency. I'm factor and I buy the trade receivables of a lot of company. So what happens to me that, as a factoring agency, people who will come to assign the debtors would, of course, be something which is going to be mainly credit impaired as well. Why would a company approach a factoring agency? Because if the debtors are good to pay. So he's going to approach a factoring agency only when he knows that they're tough debtors and there is a possibilities of non-recovery, that they're credit impaired. So for the factoring agency, those debtors they're going to make a purchase is credit impaired. So the standard is given us, you can say, a little special kind of accounting in terms of POCI. So we're not talking in terms of POCI. So even if you look in the study material, only one particular small para is given, just that you understand the concept of POCI, but there is a complete different accounting which is prescribed, a little different, because naturally that they are supposed to be credit impaired at the very inception. So the kind of a technique required to create a provision is altogether going to be different altogether. So let's make a focus in terms of a journal approach and a simplified approach. Now, let's understand what exactly is this journal and a simplified approach. So let me do one thing. Let me come out of this. I'll come back to this. Let me, I think, first understand on a time scale what exactly is the concept of a journal approach. I'm explaining you a journal approach. What exactly is the concept of a journal approach? Now, let's imagine that my company gave a loans and advance for a period of, let's say, 5 years. So this is 0 point of time, and my company gave a loan and advance, let's say, for a period of 5 years. So this is the total span. The total span of the loans and advances. I've given a loans and advance at a time 0 to 5 years time. Now, what does a journal approach require you? A journal approach says, when you made a loan at the initial recognition, do one thing, do a study of the credit risk. Do a study of a credit risk. Now you would say, sir, how would the company do a credit risk study? I'll tell you. So what do you need to do? You need to do a credit risk assessment. You need to do a credit risk assessment. Now, I'll give you a simple example as a layman to understand what is a credit risk assessment. You all know that we've all got CIBIL scores. Like for example, if you default any loans with the bank, your CIBIL score gets disturbed. So you can say my credit risk is based on the CIBIL score I have got. When I go to the bank understands that if his CIBIL score is disturbed, that means there is a huge credit risk. And if your CIBIL score is within a decent range, then they would say, okay, the credit risk is less. Similarly, for example, when you make your investments in a lot of investment securities in the market, there are certain credit rating agencies like CRISIL, and they give a credit rating to a lot of instruments, and they say that, okay, this is a triple A instrument, and this is a double A, or this is A plus instrument. So they give a rating to these instruments. The rating to these instruments is indicative of the credit risk. When the CRISIL will give a good rating to a particular instrument, then they're saying that the level of credit risk is very less. The companies may not default in terms of making the interest and your principal money back. And when you're getting a little bad rating, it indicates that there is a credit risk. So there will be a lot of techniques with the help of which a credit risk assessment is done. There are many companies also which only specialize in terms of doing a credit risk assessment for you. Tell them that for this particular financial asset, I want a credit risk assessment. They do their tools and they give you a credit risk assessment. So the standard says that you need to do a credit risk assessment at the inception. And let's assume that the credit risk inception, let's say, was low. So let's say when I gave a loan and advance to my clients, the credit risk of that particular loan was pretty low at that stage. Now, sitting on the balance sheet date, let us say at the end of the first year, what I need to do, I need to repeat this credit risk assessment. I need to now see that if there is a change which has occurred in the credit risk or not. So I need to basically sit down and evaluate that is there a change which has occurred in terms of the credit risk. So the possibility is, let's say the credit risk is still low, or the possibility is that the credit risk is increased. It has become high. So which means sitting on the balance sheet date, the company would say, okay, let me compare what was the credit risk at the inception and what is the credit risk at the end. I'm talking of a journal approach, mind you. I'm talking in terms of a journal approach. What does the standard requires me in terms of a journal approach? So I'm going to basically sit down and do a credit risk assessment and evaluate, okay, what was the credit risk at the inception and what is the credit risk at the balance sheet date? The possibility is that it is still low, or maybe let's say it is significantly high. Let us say it is significantly increased high. Now, the standard gives us some interesting inputs to watch at. Now, what did the standard say? When you did the credit risk assessment and you realize that the credit risk is still the same, there has been no significant change. So the results is either there is no significant change or there is a significant change. If there is no significant change, they say that you need to apply the concept of what is called a 12 months expected credit loss. And when there is a huge change, a significant change in the credit risk, they say you need to apply what is called a lifetime ECL. What is called a lifetime ECL. Now, what is this 12 months and what is this lifetime ECL? The concept of 12 months is if the credit risk is not increased significantly, just see what is the expected default. Calculate the probability of default over the next 12 months. Calculate the probability of default. I call it as a PD. Calculate the probability of default which is expected over the next 12 months. So why 12 months? I'm in any case going to make a balance sheet in the next 12 months. And if my credit risk compared at the inception and on the balance sheet date is not significantly changed, then I think I'm safe at this stage. I can make another review after 12 months. If I can make another review after 12 months, so I will only look at the probability of default which is going to occur in the next 12 months. But if you say that the credit risk is significantly increased, then I should consider the probability of default over the remaining life. And which is called that you should calculate a probability of default based on a lifetime. Look at what is the default probability over the entire lifetime. So the logic was fairly simple. The standard setters wanted the companies to actually, make a assessment of the credit risk, because it is the credit risk which will lead to a credit loss, mind you. It is the credit risk which will lead to a credit loss. And if the credit risk is going to lead to a credit loss and you want to create a provision for that expected credit loss, it is important to keep a track of that credit risk change. I hope you're getting the point. So if the company knows that the credit risk is what is going to trigger a credit loss and you need to create a provision for that expected credit loss, it is important to keep a track of the changes in the credit risk happening every year in. So you mean to say that again at the end of second year, the company is again going to sit down and do some credit risk assessment? Yes. This is going to be an annual review. The companies will sit down at the end of each balance sheet date, look at the credit risk at the inception, look at the credit risk on the balance sheet date, and see, is it significantly went up or significantly not went up? So if the credit risk doesn't change significantly, you can only consider the default probability, the PD, the probability of default over the next 12 months, or you will consider the probability of default over the lifetime of the instrument. This is as far as a journal approach is concerned. This is as far as a journal approach is concerned. Now, if you look at the simplified approach, in terms of the simplified approach, the standard setters were clear. No need to track the changes in the credit risk. I will not track. There is no need to track any changes in the credit risk. The tracking of the credit risk changes is required in a journal approach. But if you're using a simplified approach, use a journal approach or a simplified approach, no. The standard setters were very clear that in which cases they're going to give you a journal approach and in which cases you're going to use a simplified approach. The concept of simplified approach was applied in only certain specific cases. Most of the cases will be a case of a journal approach. So let's come to the model of the story. We're coming back out here. So in terms of the second step, once you've decided that yes, the given financial asset is within the scope of this particular standard, or the non-financial asset is within the scope of the standard, you come under the purview of the standard. And then you need to make a selection of the approach. So now let me do one thing. Let me just give you some quick inputs in terms of the differences in terms of the two approaches. So I want to first of all look into the parameter that, first of all, number one, do we need to track the changes in credit risk? Do we need to track the changes in terms of credit risk? The answer for the journal approach is a yes. Do we need to track the changes in terms of credit risk in a simplified approach? And the answer is a no. I don't need to track any changes on a credit risk when I am considering a simplified approach. That's one. Let's consider another inputs as well. Now, the other case is that this particular technique would be used in which case? Before that, let me just put some remarks out here. And the remarks out here is that if there is a significant increase in the credit risk, or if there is not a significant increase in the credit risk, you accordingly decide that in this case, we use a lifetime ECL. And if it is not significant, then we use a 12 months ECL. So after tracking the changes in the credit risk, you need to decide that if the credit risk significantly increased, then lifetime, not significantly up, then it is 12 months. And here it is only lifetime. Here it is only a lifetime ECL concept which is allowed. This is one. Now, another input. So where do we use this journal approach and where do we use this simplified approach? The standard setters again decided where do we use this particular approach. I would say by default, it is always supposed to be a journal approach only. So which cases can we use a simplified approach? The standard setter says if your account receivable does not contain a significant financing component, based on Index 115. If you've done Index 115 or you're going to do Index 115, you will see that in terms of Index 115, there can be cases where your debtors includes a significant financing component. Because they're long-term debtors, the money, the credit period which is given to them is going to be a period of more than 1 year. So it says that the simplified approach can be used in cases where the account receivable does not contain. It does not contain significant financing component. It does not contain a significant financing component. So then what happens? If the account receivable includes a significant financing component, then you're supposed to use a general approach. And you just think of this. If your debtors are supposed to be not including any significant financing component, that means what? That they are supposed to be due within a period of 12 months. And in this particular case, when you're looking at a lifetime ECL, you're looking at the next 12 months itself, effectively. So this is one case where the account receivable not containing any significant financing components can be taken. Now, another thing is that if you've got accounts receivable which contains significant accounting financing component, then it is a matter of choice for the company. Then you've got to apply an accounting policy choice. The company has to consciously decide in this case that which one do you want to follow. It's going to be an accounting policy choice in this particular case. You need to decide, am I using a simplified approach or am I using a general approach? You need to decide. I'm not getting into further details. You can say, leaving this account receivable, you can say rest by default is all going to be a general approach. So I would say, okay, the company has got account receivable, and I say, okay, there is no significant financing component. Please go ahead and use a simplified approach. No need to track changes. And in all of the cases, except if there is significant component, you get a choice. You can say by default, I'll tell them, boss, you're under general approach, and you need to decide the track changes in terms of the credit risks. I hope, friends, the second step is also pretty much clear. I guess I'm pretty much clear in this particular case as well. Yes. Now, let's go to the next step. That is step number 3, the crucial step again. So we have understood in terms of the step number 1 that whether I am under the scope of the standard. Then I've understood in terms of the step number 2 that if I'm under the standard, which approach am I using? If I'm using a general approach, I need to keep a track of the changes in the credit risk, and I'll end up using either a 12 months or lifetime expected probability of default. And if I'm under a simplified approach, I'm only supposed to use a lifetime ECL. I get a default probability based on a lifetime. Now, the step number 3 is fairly simple and fairly straight indeed. Now it is time to create a provision. For the expected credit loss. And the standard says, when you go to create a provision, you are going to consider factor number 1, EAD, factor number 2, LGD, and factor number 3, we can say PD. So you're going to consider 3 factors in terms of creating a provision in the books of accounts. The factor number 1 is called EAD. This is called exposure at default. So it is called EAD, exposure at default. Don't worry, I'll give you an example on that. And when you're looking at LGD, then it is called a loss given default. And when we say PD, the PD means it is probability of default. It is called probability of default. And I think if you remember, where do you get this default probability? You get this from your step number 2. When you applied the step number 2, a general approach and a simplified approach, you saw that what should be the probability of default I should consider. Should I look into the default probability over the next 12 months? Should I look at the default probability over the lifetime? And in a simplified approach, of course, it is by default a lifetime. So the provision for loss allowance that is unexpected, the amount expected that I may not receive, is going to be a product of 3 factors. And there could be a time where your money applied as well, if it is relevant in nature. So in this particular case, it says EAD, that is exposure at default, LGD, that is a loss given default, and it is supposed to be PD. I think, Jyoti, you asked me a question and I said you're going to get your answer in another half an hour's time. I think it's time now to give you an answer. Let's take a simple example to understand the application of this particular formula. Let's say my company gave a loan to the extent of 10 lakhs. So what is the value of the financial asset? 10 lakh. And this can be called as the exposure at default. The amount of loan which I've given, the amount of loan which I've given to my client is supposed to be indicative of the exposure at default. So let's say if I've given a loan to the extent of 10 lakh rupees, I would say this is nothing but it is exposure at default. So you are exposed that this amount may be defaulted. So the entire amount itself, the value of the financial asset is exposed at default. Now let's say there is a collateral. Let's say there is a collateral security against this loan and the realizable value. And the realizable value of this collateral is, let's say, to the extent of 8 lakh. Let's say there might be certain expenses and we're expecting certain haircuts as well. And in this particular case, the recovery is going to be to the extent of 8 lakh. So I can say that, let's say, if this fellow doesn't pay my money, even if he doesn't pay my money, what is the maximum loss I'm going to get? Can I say 2 lakhs? Because if he doesn't pay me 10 lakh, I would still be able to recover 8 lakh. So we can say if somebody were to tell me what is a recovery rate, I would say the recovery rate is 8 by 10, it is 80%. The recovery rate is 80%. That means if this fellow doesn't pay the money, you are still bound to recover 80% of the money. And when you say LGD, it is called 1 minus the recovery rate. In this given example, we can say 1 minus 0.8, we can say 20% is the loss given default. So when you look at LGD, it is 1 minus the recovery rate. You can directly get it as well, that out of this 10 lakh rupees, 8 lakhs will be recovered. So what is not recovered is 2 lakh. What is not recovered is the given default. So which means today, if this fellow doesn't pay money, I've got a 20% default, loss given default. So in this particular case, if I were to create a provision, I would say, okay, this is the exposure at default, but what is the maximum money which may become irrecoverable is 20%. But I'm not going to create a provision for the entire 2 lakhs. Because this 2 lakhs has got a certain probability that, what is the probability of this 2 lakh not getting recovered? So I've already calculated in step 2 that what is the probability of a default, how much money you may not collect in the next 12 months or over the lifetime. So you multiply this, let's say the probability of default is 5%. So this is called EAD into the LGD into the PD, and this probability of default is either based on a 12 months or it is based on a lifetime. And when you take a product of all these factors, you will get the amount of provisioning which is done. So in this particular case, I can say on 10 lakh, 20% into 5%, I'm going to create a provision to the extent of 10,000 against the financial asset. So this is how a basic overview in terms of the 3-step model applies. I need to do some questions, of course, with you. There are some more inputs which I need to explain, but with the questions itself. But you need to keep the larger picture in mind that the concept of ECL is based on a simple 3-step model. At the first instance, you need to see that the given asset, whether it's financial or it's non-financial, is it within the scope of the standard or not? So I would put it like this, that all financial assets measured at AC and at OCIR, and you can say the non-financial asset, contract asset, is within the purview of the standard. They will be tested for impairment. Then I need to zero down in terms of step 2, which approach am I going to use? And by default, it is a journal approach, though in terms of account receivable, which does not contain a significant financing component, you are allowed to use a simplified approach. And by default, it is always a journal approach. And what does a journal approach require? That a credit loss depends upon a credit risk. And if it depends upon a credit risk, please track the changes in the credit risk. If you make an assessment and you find that the credit risk is significantly increasing year by year, then at the end of each year, decide, are you going to consider a default probability over the next 12 months or lifetime? But in a simplified approach, they said no need to track any changes and you simply consider provisioning based on, you can say, a lifetime ECL. And step number two, with the help of the tracking changes of the credit risk, or if it is a general approach, you get a default probability. And then it is a simple product of these three in terms of step number three, getting a provisioning, which is get the exposure at default, multiply this with the loss given default and the probability computed in step two, you get the amount of provisionings to be done. I hope, friends, I am pretty much clear so far indeed, right? Do let me know if you've got an overview. I think, Jyoti, you would have got your answer as well, what you asked me at the very inception. Now, let's go a little further. Let's try with this knowledge whether we can do some questions or not. I've taken a mix of questions, and with these particular questions, you're going to get some exposure. Let's say in terms of evaluating a credit risk, for example, or creating directly an amount of provisionings. Let's start with some basic questions to go with, and then we'll increase the level slowly and steadily. So what I've done, I've taken a few questions, selected some questions here and there. So let me share the questions to you, and I am going to carry on the exercise with you. Okay, so I think let's start with a very simple little question. I've taken a few selected questions here and there. So let me, I think, share this particular question. Okay, let me zoom this further. This is one of the questions which is similar in terms of what came in the RTPs as well. And I'm going to look at this particular question. We're going to start with a very simple question to begin with, and then we'll slowly increase the level in terms of the question. Let's have a look. Let's have a look at this particular question. It says an entity purchases a debt instrument for 1,000 on 1st January X1, and it says the interest rate on the bond is the same as the effective rate of interest. So the EIR and the contracted rate is same. It says after accounting for the interest for the year ended 31st December X1, the carrying amount of the bond is still 1,000. So we're sitting at the end of the first year. We're sitting at the end of the first year and we receive the interest, and then the bond is 1,000. Now let me just explain this a bit to you so that we stand at a same footing. If you just try to visualize that this particular account, this particular financial asset being a debt instrument was, let's say, accounted using, let's say, amortized cost approach. I'm just trying to gather the previous knowledge. Then I can say an accounting would have occurred something like this. On the initial recognition, you would have recorded this investment financial asset to bank, that is 1,000. So when you made a purchase of 1,000, considering that is the fair value at the initial recognition, then based on amortized cost accounting, you would have accrued a finance income, and then you would have received the interest as well. Now, in this case, I'm not given that what is the contracted rate of interest. So we can say one thing, that if this was accrued at the contracted rate, and this is accrued at the effective interest rate, because the interest must have been accrued using EIR, and the money received would have been at a contracted rate. Now, we're very clearly given that the contracted rate and the EIR is same, which means the figure of finance income and the bank balance is same. So you would naturally get the balance CD as 1,000 itself. So this is what he's trying to tell me at the very inception. Now, if you read the question once again, it says, entity purchases a debt instruments on January X1, interest rate is same as effective rate. The interest rate is same as the effective rate. So after accounting for the interest on December, the carrying amount is still 1,000. This is what they might have done. Then he says at the reporting date, that is December X1, the fair value of the instrument is fallen to 950. Now, the fair value of this particular instrument is fallen down to 950. Now, it says further, the fair value of the instrument has gone down to 950. There has not been a significant increase in the credit risk since the inception. So the expected credit losses is measured at a 12 months loss. This is deemed to be 30. This is deemed to be 30. Now, we are given some inputs that in this particular case, the company did a, you can say, a credit risk assessment. Let me just go back to my 3-step model and just let's evaluate. So let's apply the step number 1, let's apply the step number 2, and let's apply the step number 3 and decide. When an entity purchased a debt instrument, it says when an entity purchased a debt instrument, I can say it is a financial asset which is measured at AC. Why did I say AC? Because the interest rate in the bond is the same as effective rate. You do not apply the concept of EIR unless the category is AC or OCI. So in this particular case, let's assume for a moment that instead of AC, this is, let's say, FPT OCI. Let's assume that instead of AC, please mind the words carefully. Let's assume that instead of AC, it is FPT OCI. Can I say instead of taking the balance CD as 1,000, you will take a balance CD 950. Had it been amortized cost accounting, you would have taken 1,000. But if it is supposed to be FPT OCI, you would have taken 950. The concept of EIR is applicable to AC as well as OCIR. I hope you remember all that. So in this particular case, what you would have done, this difference of 50 would have been taken to OCI, correct? If I would have measured this debt investments at OCI, then I would have said any difference in the ledger account is going to be a fair value change and it's going to be taken in the OCI. Okay. So in terms of step 1, it is a financial asset, which is, let's assume, measured at FPT OCIR. So is it within the scope of the standard? Yes, it is within the scope of the standard. The second question is, which approach would I apply? It's not an account receivable. It's not an account receivable. So which approach am I going to apply? I'm going to apply a journal approach. And if you're going to apply a journal approach, you need to do a credit risk assessment. And he's done that. It says at the reporting date, the fair value is gone down. There has not been a significant increase since inception. So the ECL should be taken as 12 months. He's already applied the credit risk assessment and he's decided that under the journal approach, we conclude that we're going to consider a default probability, which is based on a 12-month cycle. Now, the next part is, it says, so the expected credit loss is taken and this is deemed to be 30. He's already given you that what is the expected credit loss. The figure is given, that is 30. So he's already given us that the figure is equal to 30. So we know the results, that I am supposed to create an impairment loss of 30. Now watch this carefully. In this particular case, if no impairment was there, I would have taken the entire 50 in the OCI. But since there is an impairment, to the extent of 30 will enter the P&L and the remaining 20 will enter the OCI. So the entry in this particular case is profit and loss gets a debit to the extent of the impairment loss, which is 30. And the fair value changes, that is the remaining 20, enters in the OCI, and the financial asset gets a credit to the extent of 50. So this is the entry which we're going to pass. So in this question, there was no need in terms of doing the calculations of things. We were fairly given everything directly itself. I hope, friends, I'm pretty much clear on this particular example, a basic one to begin with. A basic one to begin with. Okay, let's, I think, go to another one. Let's have a look further and let's consider a little more complicated one. another question out here. So let's put this as 1. And let's go to this one. Let's take this as 2. Now let's see the facts given in this case. It says on 1st January, 1st February X6, Eve made a 4-year loan of 10,000 to Fern, and the coupon rate of the loan, which is a contracted rate, is 6%, and it is same as the effective rate of interest. Now, one thing is very clear, that the moment you're applying the concept of EIR, it is certainly a debt investments. Either it is measured at ACA or it is measured at OCIR. Because the concept of EIR doesn't apply to the concept of OCINR. Equity investments don't consider that. We've said that earlier as well, that the concept of EIR triggers only in terms of AC or OCIR. So when it gives you the information regarding the coupon rate is same as the effective rate, interest is received at the end of each year. Then he says on 1st February X9, Fern tells Eve that it is in a significant financial difficulties. It is in a significant financial difficulties. And at this time, the current market rate is 8. Well, I'm not concerned with the current market rate in this case. Then he says Eve estimates it will receive no more interest from Fern. It also estimates that only 6,000 of the capital will be repaid on the redemption date. So we know that the loan is for a period of 4 years. That means the maturity is X10. The maturity is supposed to be X10. And now 3 years have already passed, and sitting at the end of 3rd year, it says Fern tells Eve, Fern is your loan holder, who tells you that, okay, I'm in significant difficulties and I will not be able to pay you. So Eve is estimating I'll get no more interest and I will only get a principal money, that is 6,000. Eve has already recognized a loss allowance of 1,000 in respect of loan to the firm. Now, in this particular case, let's consider that this is supposed to be a case of, let's say, amortized cost. Let's apply the 3-step model once again and evaluate. So in this particular case, I go to the step number 1, step number 2, and step number 3, and let's see what is the provision to be created. Now, in this particular case, it is undoubtedly a loan, so it is a financial asset measured at AC. Undoubtedly, it is within the scope of the standard. Then I go to the step number 2, and it is supposed to be a loan. It's not a case of account receivable. And if it is not a case of account receivable, I am using a journal approach in this particular case. I'm using a journal approach in this particular case because it's not an account receivable. So changes in the credit risk is to be done. And there is huge credit risk. It says the person to whom you gave the loan himself is saying, I am in financial difficulties, which means the credit risk must have substantially increased. And if it is substantially increased, I'm going to consider the lifetime ECL in this particular case. I'm now going to consider that whatever is the remaining tenure of this particular loan, what is the expected amount which I would not receive. So I need to consider the defaults which will take place in this particular case. So I'm very clearly given, I'm not going to get any interest further. I'm only going to get 6,000. Now, there are two things. Either you calculate what I will not get, or you calculate what I will get. It's one and the same thing. It's one and the same thing. Either you calculate what I will not get. Now, let me tell you, you are not going to get interest on 10,000 at 6%. That is 600. You're not going to get 4,000 principal. So either you calculate this is what I'm not going to get, or you calculate what you're going to get. Let me calculate what I'm going to get. Let me calculate what I'm going to get. I'll tell you why I'm doing that to ease my calculations. So sitting at February X9, I know that after 1 year, I will only get a principal repayment of 6,000. So this is what I'm going to get after 1 year. If this is what I'm going to get after 1 year, let me also apply the time value of money. And this will be using the original EIR. I don't need to consider any market rate of interest. The standard is very clear that if you're calculating the amount of shortfalls, consider the original EIR itself. The original EIR is 6%. So this money is what you're going to get after 1 year. So let's do the discounting at the rate of 6%. So 6,000 divided by 1.06 for a period of 1 year. So this is what you are going to get. This is what you're going to get. So what is the book value of this particular asset? Considering that the accounting is based on AC, the contract rate and the effective rate is same, which means the finance income due and the money received is equal. So the book value will continue to be 1,000 every year. So we can say that the book value of this asset is to the extent of 10,000. So this is the book value and this is what you're expecting to get. So what will you not get can be calculated as a balancing figure. Because at the end of the day, I need what I'm not going to get. I need what I'm not going to get. So in this particular case, we calculate what I'm not going to get. So we can say 10,000 minus 5660, what you're expecting to receive, 4340 is what you're not going to get. But the company has already created a provision to the extent of 1,000. So you just need to create a provision for the remaining balance. So in this particular case, if I were to calculate the provision to be recognized, we can say 4340 is what you're not going to receive. 1,000 you've already created a provision. So you need to create a further provision. You need to create a further provision to this extent. Right. So you can see one question I did where the amount of provisioning was already given. And the other one, what I did, let me tell you what I did in this illustration. I have taken the present value of the cash shortfall. Please mind the words carefully. What I've done in this particular case, I have calculated that the credit risk is leading to, you can say, a credit loss. So what is the credit loss? You're saying, let me calculate what is contractually I'm going to get. I'm supposed to get 600 at the end of another 1 year. I'm supposed to get 10,000 at the end of 1 year. But I'm not going to get this 600. I'm only going to get 6,000. So you need to technically calculate the present value of shortfalls. Now, in order to calculate the present value of shortfalls, one thing is you calculate what you're not going to get. You directly calculate what you're not going to calculate, not going to get, calculate the present value. That is the present value of the cash shortfall. But in this case, what I did the other way around, which is one of the same thing. I just calculated what is the money I'm going to get after 1 year. So out of the book value, I know what I'm not going to get. So you need to create a provision for the remaining, and there is already an existing provision. So we created further provisions in the book. I guess so far so good. I hope you got the hangs of this. Okay, I think no questions coming in so far. Going too technical or everything clear, I guess. Let's take you now to another interesting inputs. And I'm now taking, and by the way, there is another interesting input which I like to put you at this stage. The question also arises that sitting at the end of 1st February X9, now when you're going to record the interest income for the next 12 months, you're going to calculate the interest income on what particular figure? Are you going to accrue the interest on the gross amount, which is 10,000, or are you going to accrue the interest on the net amount, which is after the provision for loss? Now here, the standard says something very interesting. If you say that there is increase in the credit risk, you can continue to record the interest income on the gross amount of the loan, which in this case is 10,000. So if your credit risk is increased, you can still continue to recognize the amount of interest on the gross value of the asset, and which is to the extent of 10,000. But if your financial asset is credit impaired, like in this particular case, the person to whom you gave the loan is saying, I'm in financial difficulties, which means you already know that you're not going to get money. So your asset is credit impaired. In this case, the interest income is going to be taken on a net amount. So when the company is going to book an interest, in this case, when the company is going to book an interest for the year, you can say X9, X10. When the company is going to book an interest for the year X9, X10, you are going to calculate the interest on the net amount, which is supposed to be, you can say, a total of 5660. So on this 5660, you're going to accrue interest at the rate of 6%. So if your asset becomes credit impaired, the interest income to be taken in the books of accounts is also going to reduce on the net amount. But if it is not credit impaired, even though the credit risk significantly increases, we'll still be under the purview and we're going to consider the interest on 10,000 itself. That was a very interesting point indeed. Okay, let's have a look at another question further. Let me take you to another question out here. I guess let's have a slow look at a question below. I hope that's pretty visible. I think so. Now let's have a look at another question with you. And I'm looking at this. Let me put this as question number 3. Then I'll do this. That is question number 4 with you. And that takes care of the entire inputs on ECL modeling in this case. Now let's have a look further on this question 3. It says on 1st January X1, NABA purchased a bond for 1 million, which is measured at AC. Now this time is very clear that we're measuring it AC. Because in the very first question which we did, I assumed it to be OCI because I wanted to give you the inputs in terms of what goes in the OCI, what goes in the P&L. Second one, I comfortably assumed an AC, and this time he's given AC. Interest of 10% is payable in arrears, and the repayment is due on December X3, which is supposed to be at the end of another 3 years. The effective rate of interest is also 10%. The contracted rate and the effective rate is same. So one thing is pretty clear, that in this particular case also the same logics would apply. If I were to just make a ledger account again for a better understanding. So if I were to just make a ledger account of the financial asset for a better understanding. So we can say that when the bond is purchased at 1 million, so let's say this is the fair value, 1 million would mean 10 lakhs. You would have taken the finance income accrued on effective interest rate. Then at the end of the year, you would have received the contracted rate and you would have taken the balance CD as a balancing figure. Now, in this case as well, the contracted rate is 10 and the effective rate is supposed to be 10. So if these are equal, we can say the balancing figure undoubtedly is going to be 10 lakh. So in this particular case, we can comfortably say that if the effective rate of interest and the contracted rate is equal, the balance CD is 10 lakh. Let's see further. Then he says NAPA received, it says interest of 1 lakh at the end of the first year. It estimated the probability of default on the bond within the next 12 months is going to be 0.5%. If the default occurs within the next 12 months, then NAPA estimates no further interest will be received and only 50% of the capital will be repaid on December X3. Now, watch this carefully. It says on 31st December X1, NAPA received interest. So I am sitting at the end of first year, I received the interest. And in this particular case, it says you estimate the probability of default is 0.5% over the next 12 months. And if the default occurs within the next 12 months, then you estimate no further amount to be received and only 50% will be paid on December X3. The asset credit risk on December X1 is low. Discuss the accounting treatment of the financial asset on December X1. So I think let me go back to my 3-step model and see the evaluations in this case. So let's have a look in terms of the step number 1, step number 2, and step number 3. And let's consider what is the provisions to be made in this case. Number 1, this is a case of a bond. So it is a financial asset measured at amortized cost. So undoubtedly it is within the scope of this standard. And then I go to the approach. It is not a case of account receivable. If it is not a case of account receivable, we are using a general approach in this particular case. And once you apply a general approach, you need to make an evaluation on the significant changes in the credit risk. It says the credit risk on December X1 is low. If the credit risk in this case is low, we can undoubtedly say that we're using a 12 months ECL in this case. So when you're going to create a provision for ECL in this particular case, now what are you going to do in this particular case? you need to consider what is the exposure at default. You need to consider what is the exposure at default. And then you need to multiply it with the LGD, and you need to multiply with the PD. And in this particular case, you're already given the PD. The probability of default is 0.5%. And in this particular case, you need to consider what is the loss given default. Now, in this particular case, I'm not given that there is any collateral which is there against this financial asset, which means let's look at a scenario that in this particular case, what is the amount I may not receive? It says if a default occurs within the next 12 months, then you estimate no further interest will be received and only 50% of the capital is going to be received. So what are you going to receive? Let's calculate that. Let's calculate what are you going to receive in this particular case. So unlike in the previous case, what I did the calculations of what you're not going to get. So I first took what you're going to get, and then I did the calculations of what you're not getting. Now, in this particular case, we can say you're going to calculate that what is the amount which is exposed, what is the amount which is exposed to default. I want to calculate the amount which is exposure at default, though LGD is not given and we need a PD. I'm not given a collateral, so there is no LGD. Now, what is the amount which is exposed to default? Can I say the interest one, which is not expected, exposure at default, and number two, 50% of the amount. So we can say no interest will be received, which means on this 10 lakh, 1 lakh not expected to be received 1 year later, then another 1 lakh not expected another 2 years later, and another 5 lakhs not expected another 2 years later. So we can say what is the exposure at a default. So what is the amount which is exposed to a default? The money which you're not going to get. The money which you're not going to get is exposed at default. So we can say 1 lakh at the end of X2 and 1 lakh at the end of X3. This is the money which is exposed at default because he told me what I'm going to get. So I'm calculating what I will not get. I will not get the interest in the next 2 years and discount this at the rate of 10%. This is at the end of second year. This is also at the end of second year. This is the exposure at default, and the probability of default is given 0.5%. So this is the amount of provision which you need to create in the books of accounts. So another interesting question which is there in terms of how much provision is to be created. So we need to go with a simple 3-step model understanding. Is it in the scope? Which approach are you using? Calculate the exposure at default. Of course, if this is the money which will be defaulted that you're not going to get, what is exposed to default? Because you know that you're going to get the money, only 50% money will be repaid. So calculate what you're not expecting to get. That is what is exposed to default. And then multiply it with the PD, the default probability. You get the provisions to be created in the books of accounts. I hope, friends, that is pretty much clear indeed. And Prashant, you said, sir, in question 1, on which amount would the finance income be credited for a further year? In terms of question number 1. Well, in terms of question number 1, in this particular case, we are not again saying that there is any credit impairment. So again, gross amount. The interest in this case is again going to be taken on the gross figure itself. It is only when it gets credit impaired, then the interest will be taken on the basis of net. If you say low risk, if you say significantly high risk, it is still gross. But if you say it is credit impaired, like in this case, then only net. Even in the question number 3, if you ask me the interest accrual, since the credit risk is low, the interest accrued would be on the gross amount itself. So even in this case, I think it's worth making a mention that if I were to consider the interest accrual, I'm going to consider the interest on a gross amount itself. Let's now do another question with you, and then I think we'll give you a break after that. So let me just finish this so that we can do embedded derivatives post that. So let's go back to another question, the last question in terms of impairment. A similar question is given in the study material, but I found out some more additional questions for you. I thought maybe you can do those questions as practice. Let me put some additional questions to you. It says Jane's trade receivables are short term and they do not contain a significant financing component. I think it goes without saying. Now, this is a case where a simplified approach will be applied because it is a case of an account receivable with no significant financing. So if I were to apply my three-step model quickly, I would say in this particular case, step number one, it is an account receivable, definitely under the scope of the standard. We are going to use a simplified approach because this is account receivable. So when you're going to use a simplified approach, no risk assessment is required. So we're going to use a lifetime ECL for sure. And we need to consider the amount of provision as well. And there is a little logic in terms of taking this question with you. When you consider a provisioning for an account receivable under simplified approach, there is a practical expedient which is given in the standard. Now you would say, what do you mean by a practical expedient? The practical expedient is that you want to expedite the process of creating a provision in the books. So when a company uses a simplified approach, typically in terms of account receivable, I'm saying simply in terms of account receivable, the standard says that the provision can be created using what is called a matrix approach. So this is something which is called a practical expedient that companies, while creating a provisions, could create a matrix approach. What is this matrix approach? We're going to see in the question. Let's have a look now. Let's read further. It says Jane's trade receivables are short-term and do not contain any significant financing component. Using historical observed default rates, updated for changes in forward-looking estimates, Jane estimates the following default rates for its trade receivable outstanding. Then I give you at the very inception that what a company needs to do, they're going to make a projections in terms of the rates. Get your historical rates, do a forward-looking, apply the macro micro factors and get the updated default rate. So this is the estimated default rate. So we are given expected default rates based on the matrix. What is the matrix? We can say there are certain debtors not overdue. There are certain debtors which are overdue for 30 days. There are certain debtors which are overdue 31 to 60 and so on. So depending upon the aging analysis of the overdue amount of debtors, a default rate was taken on historical observed, and then it was forward-looking was done and the default rates are given. This is the carrying amount based on the matrix approach. So what I need to do in this particular case, you're going to multiply these amounts with the respective rates of 0.5%, 1.5%, 6.1%, and 16.5%, as simple as that. So since I'm already given that this is the amount which is exposure at default, and this is the default rate, you just multiply and you get the figure. And in this particular case, it says there is already a loss allowance in the previous financials. So whatever figure comes out here, you got to reduce that by 0.2 million in this case. So this is the total provision which is required, and this is the existing provision. So you create a balance, discuss the accounting treatment of the loss allowance in the financial. So this is a case which is applicable only in terms of account receivable, where you use a simplified approach to those account receivable where you can say the significant financing component is not present. In those cases, a provisions can be created based on the gross carrying amount, EAD, and the default rates, which is historical converted into expected rates. Right, friends, so that gives us a complete exposure. In terms of impairment, you can try questions now in the study material as well. Trust me, you're going to see similar questions. This kind of a question is also given, a direct question in terms of multiplying three factors given. So this is all as far as impairment from the examination perspective is concerned. So I hope you've understood it well. I know it's a little complicated affair, but I hope you've understood the concept in this case. Okay, so I think so far so good. I think it's time to give you a break as well. I'm sure you need one. So I'm going to carry on the last aspect on financial instruments, which is on the embedded derivative. It is slightly technical, but very interesting at the same time. So let's give you a break for around 10, 12 minutes time. So almost 7:46 or so. So 10, 12 minutes, friends. We're going to be back. Enjoy your break. Welcome back, friends. I hope you relax your mind for a change of topic. And now we're going to discuss the last section of financial instruments, and that is the concept of embedded derivative. We've already discussed the concept of what are derivatives, and we've also discussed the accounting treatment of derivative. Now I'm going to basically take you to the concept of what is called embedded derivative. So there is a very interesting chart which is given, and I'll first make you walk through on that particular chart, and then we're going to do a practical illustration understanding how the accounting in terms of embedded derivatives are done. So I'm carrying with me the study material, and there is a very interesting chart which is given in the study material. Let's, I guess, take you to that interesting chart which is given in the study mat. Here it goes, and that's a very interesting chart indeed. Let me, I guess, share the inputs. Now, this is going to be slightly technical, but I'll explain with an example, and just watch this very carefully. I hope the visibility is perfectly okay, I guess. Okay, let's, I think, begin the journey. So maybe I think I can take this on the top. We'll perhaps look at this. Yes, I think that's good to go. Now, watch this carefully. I'm again going to convert the concept into a three-step model to make your life simple. Now, we are discussing the concept of what we call hybrid contract. So I would say what you need to do at the first instance is you need to identify, is the contract hybrid in nature? So what do you need to do? You need to first of all see, is the contract hybrid in nature? How would I analyze that the contract is hybrid in nature? No worry. We'll explain you that with an example, but I think let me put my step number one very clear. So I'm saying my step number one is, I'll give you the detailed notes later. We just need to focus that the contract is hybrid in nature. Now, the question rises, what is a hybrid contract? Well, I can say a contract which contains a non-derivative as well as a derivative is called hybrid in nature. Now, put it differently, a contract which contains a non-derivative is the host. And there is also a derivative which is embedded in the instrument. I'll put it again. So we are saying a contract has got two components. One is a non-derivative and one is a derivative. So when I say it has got a non-derivative, it is called a host, and the derivative is called the embedded derivative. So let's take an example to understand what is this concept. So there is a small little example which is given in the study. Let's have a look at that illustration 9. It says a lease contract contains, okay, I think let's not take this example. Let's give you a little more simpler example so that we can, I think, get the basic knack. Let's assume that I have to purchase, let's say, a machine in a foreign currency. Please mind the words very carefully. Every word is going to be important because the remaining portion, including accounting, is going to be slightly complicated, but you'll get it. Please mind each and every word carefully. So let's say, for example, I have to purchase a machine. Let's say I got to purchase a machine, and this machine is going to be bought in a foreign currency. The machine is going to be bought in a foreign currency. Now, in this particular case, you can say, is the amount which you're going to pay, is it going to be fixed or will it change? Well, I would say, yes, it will undergo change. Because if there is a change in the rate of exchange, then what will happen? Due to a change in the exchange rate, the outflows could undergo a change. On the contrary, just imagine if you were to buy a machine, let's say in the functional currency itself. Let's say if you were to buy a machine in a functional currency itself, then there would be no fluctuations at all. So look at the two transactions. You're going to buy a machine in a functional currency. So would the cash flows vary or would the cash flows be the same? The cash flows would be the same. But if you go to buy a machinery in a foreign currency, the amount of cash flows will undergo a change. And it is only because the contract is expressed in a foreign currency. So which means the cash flows are varying due to, you can say, the exchange rate fluctuations. So we can say there is a non-derivative contract which is supposed to be to buy a machine, which is a non-derivative contract. It is going to be called as a host, and there is, you can say, an exchange rate fluctuations, which is a derivative embedded in the instrument. So we really didn't get this much. We understood the example, but we could not make much out of it. Okay, let's, I think, put it now in a different manner. Imagine if you look at a pure derivative contract. A pure derivative contract could lead to changes in the cash flow. And if in a particular contract you insert the derivative and it leads to changes in the cash flow due to the presence of the derivative, please mind the words. So I'm saying that let's say there is a pure derivative and that pure derivative would lead to, you can say, changes in the cash flow. When you insert the derivative into a contract, it leads to fluctuations in the cash flow. Had it not been there, the fluctuations in the cash flows would not have taken place. So let's put it like this now. Let's consider the example. You want to buy a machine in a functional currency, so there is no variations in the cash flow. But you're looking at that, okay, I'm going to buy in a foreign currency. So what is that factor? What is that factor which will lead to the changes in terms of cash flow? It is the exchange rate fluctuations which will lead to the changes in the cash flow. This is, you can say, the embedded derivative in the instrument. So the standard requires that if any particular factor, to put it into simple words, if any particular factor would lead to changes in the cash flow, if that factor would not have been there, then I can say that is an embedded derivative. So try to identify what is the factor which leads to the fluctuations in the cash flow, and see if that factor would not have been there, the fluctuations in the cash flows would not have taken place. So you mean to say that if there is a purchase of a machinery in foreign currency, there is a derivative because fluctuations will take place due to exchange rate? So you mean to say that even if there is a sale of a machinery in a foreign currency, then also lead to fluctuations? Yes. So that means if I enter into any kind of contract, let's say a construction contract in a foreign currency, would that also lead to fluctuations? Yes. So look at a particular contract and see that what is that factor? What is that factor which leads to the fluctuations? And the easy way out is see, if this factor was not there, fluctuations would not have taken place. Because of this factor, the fluctuations are taking place. So I would say that factor is supposed to be an embedded derivative. So in this particular case, when you say that you're going to buy a machine in a foreign currency, I would say, okay, if I were to buy a machine in a functional currency, fluctuations are not there. This is host. And it is in a foreign currency. So this foreign currency is leading to the fluctuation. It is the derivative embedded. So the first thing what you need to do is you need to identify that the contract is hybrid in nature. This is what you need to do in terms of step number 1. Now, once you say that, yes, it is a hybrid contract, at the same time, it is a good practice to identify what is the host in this contract and what is the ED, the embedded derivative in the contract. So the step number 1 is identify, is it hybrid? 1. And then simultaneously segregate that in this hybrid contract, what is the host and what is the derivative, what is the ED that leads to the change in the fluctuations of the contract. This is the factor which leads to fluctuations in terms of inflows and outflow. So in this example, the foreign currency exchange rate fluctuations is the ED and buying the machine is supposed to be a host. Now let's go to the step number two. So once you've done that in terms of step number one, you're going to go to the step number two in this case. Now, in terms of the step number two, the standard requires that you need to see where the ED is to be segregated. Now, let's go back to the chart. Let's go back to the chart and have a look. It says, does the hybrid contract, as I said, you've already identified it is hybrid. It contains a host that is an asset within the scope of Ind AS 109. Now, that's really important to see. In step number two, you need to see that the host number one is an asset. And number two, it is within the scope of the standard. So mind it carefully. You need to go to the step number two and you need to see that the host which you are talking of is number one, an asset, that is one. And number two, it is in the scope of Ind AS 109. You need to put across two questions to yourself. You need to put across two questions to yourself that the host. Now let's take this example. In my example, buying this machine is the host contract. Is a machine an asset? Yes, the machine is an asset. Is this within the scope of the standard? No, because it is a non-financial asset and it is not within the scope of the standard. So it says you need to put across a question that it is an asset one within the scope of the standard, that is two. Now, once you put across this question and your answer comes yes, don't separate the ED. So if you're saying that the asset is within the scope of the Ind AS, the asset is within the scope of this Ind AS. So what are the two parameters? Number one, it is an asset. And number two, it is in the scope. Any one condition fails, you are going to come out here. Now let me say something more technical, friends, to you. If I say it is a liability, then it's not an asset. Then the answer is no. If I say it is a equity instrument, it is not an asset. So can I say if I am an issuer, and I'm going to issue an instrument which contains ED. Please mind the words carefully. If I am an issuer and I issue an instrument which contains an ED, is that instrument an asset? No, it's not an asset. If it is not an asset, I don't care whether it is within the scope of the standard or not. Because the two conditions are met, ED is not segregated. Any one condition fails, ED is segregated. So, what does this technically mean? Let's understand this in simple terms. Let's imagine that this is the balance sheet in a T-shaped format. So I would say that you've got, you can say financial assets, you've got non-financial assets, you've got equity instruments, you've got liabilities, which are supposed to be financial liabilities as well as non-financial liabilities. Now watch me carefully. I am saying the step number two is it an asset? Number one, within the scope of the standard, only then you will not segregate the ED. Which means I am only not going to segregate. I'm only not going to segregate the embedded derivative in financial assets per se. If there is an equity instrument, if there is a liability, if there is a non-financial asset, I will segregate the ED because they are not assets. Either they are not assets or they are assets not in the scope. I hope you got my point. I know it's a very complicated affair because if you start looking at this in a practical life conditions, it can become very complicated indeed. But let me put this once again. Because we'll do the accounting, but before we do the accounting, I think I need to explain you also what exactly is happening. So let me just consolidate the learning so far. At the first instance, you need to see that it is supposed to be hybrid contract. How do you identify that the contract is hybrid in nature? Don't worry, I'll give you document the detailed steps later. So how do you identify that it is a hybrid contract? I'll say, please tell me, is there any factor in this contract which is leading to cash flow changing? Had this factor not been there, the cash flows would not have undergone a change. So I think the easiest examples to understand is when a company enters into any kind of foreign currency transactions, whether it is a sale or whether it is a purchase, I would say it is always hybrid in nature. Because your cash outflows or your cash inflows on the contract will vary because of that exchange rate movements. Had the purchase and sale been in a functional currency, the cash flow movements would not have undergone a change. So what is that factor in the contract which is leading to fluctuations in the cash flow? It is the exchange rate fluctuations which is leading to the, you can say, fluctuations which is leading to the cash inflow outflow changing. So we can say that is the ED. That factor which is leading to the changes in the cash flow, that is the ED. So this kind of a contract is called hybrid in nature. So at the first instance, see that is it hybrid, and if yes, simultaneously calculate the host contract which is non-derivative, and also identify that ED which is called embedded derivative. Now, once you know that it is a hybrid and this is the host and this is the ED, you need to go to the step number 2 and identify, is there a need to need to segregate that ED or not. So the standard is given 2 parameters where ED is not segregated. The standard is given us 2 parameters where ED is not segregated. The parameter number 1 is that the host is an asset. Number 2, that asset within the scope of 109. So the only cases where you can say the ED is not segregated is going to be financial assets per se. So when I say it is a financial asset, is it an asset? Yes. Is it in the scope of this index? Yes. So there is no need to segregate the ED. So if it is not an asset, it's a liability, it's an equity instrument, or it is an asset, but it is non-financial, therefore it is not in the scope of the standard, the ED is to be segregated. Let's now go to the step number 3. Let's now go to the step number 3. So here it says separate embedded derivatives that fulfill certain conditions. Now you go to the step number 3. Even if you said it is not an asset, 1, or it is an asset but not in the scope of the standard, you went to the step number 3. You went to the step number 3. Now, in terms of step number 3, the standard has given us a set of 3 conditions. The standard has given us a set of 3 conditions. If you are able to meet these 3 conditions, then ED is segregated. If you fail any one, ED is not segregated. Sir, this is too technical indeed. I know what I'm saying is very technical indeed, but you need to get first of all the larger concept in terms of thing. Now let's have a look at the three conditions. It says the economic characteristics and the risk of the ED are closely related to those of the host. I'll now tell you, what do you need to prove? What do you need to prove? If you want to segregate the ED, please mind the words. If you want to segregate the ED, you need to prove what I call it as EC and R, economic characteristics and risk. They are not closely related. The economic characteristic and risk of the host and the economic characteristics and risk of the ED are not closely related. Sir, but here it is written they are related. Well, if they are related, I will not be segregating ED. So I am saying that in condition number one, you need to prove that the EC and R are not closely related. Sir, how do we prove that the EC and R are closely related or not? The standard has given us a plethora of examples. Even in the study material, you'll see a couple of examples given where the EC and R test is being conducted in terms of identifying. But I'll not get into those lengths. I'll basically come to the accounting part. So this is condition one. Second, it says a separate instrument with the same terms as ED would meet the definition of a derivative. You need to basically prove me that the ED has got the same three characteristics of a derivative which we identified earlier. So you need to see that if I take this ED out from the hybrid instrument, will it meet the three characteristics which we said? Number one, it derives its value from the underlying asset. Number two, you prove it to me initial amount of investment is negligible. And number three, prove it to me that there is going to be future settlement. So prove it to me that the ED, if taken out from the hybrid instrument, will meet the three definition characteristics of a derivative. That is two. Three, the hybrid contract is not measured at FPTPL. The company is got a choice of designating the hybrid instrument to be measured at FPTPL in its entirety. The standard is giving you a choice that you can measure the entire hybrid instruments at FPTPL without segregating ED. If the company designated the entire instrument at FPTPL, so what do you need to see? The three conditions are: number one, the EC and R are not closely related. The EC and R of the host, the EC and R of the embedded derivative should not be closely related. One. The second is that the ED, if taken out from the hybrid, meets the three definitions of a derivative. And number three, the company should have not designated the hybrid instrument to be measured at FPTPL. If the three conditions are met, I will segregate the ED and account it separately. And if I fail any of the conditions, then the entire instrument measured at FPTPL. Sir, how will we identify it is a host or a ghost? Sir, how will I look into these three conditions? This is going to be too technical in life. The practical illustrations which are given and have come in the exam so far already evaluate these parameters, and they only tell you that these conditions are met, please segregate ED. But at the larger level, you should also understand what is the input. So let me consolidate the learnings and give you a three-step model as well. Okay, Viraj, you said, this is, I think, a law question coming in, I guess, maybe. I think there is a little overlapping of some questions coming from the class happening intermediate, I think, at times. People might log it into the final, send intermediate questions. So let me consolidate the picture and give you a simple three-step model in terms of how the ED is to be decided. So I'm looking at the three-step model, and then we'll see the accounting as well. Let's get the clarity in terms of a three-step model, that in which cases the ED is to be segregated, in which cases it is not. So you're going to start the journey in terms of step number one. In terms of step number one, we will see, is it a hybrid contract? The first thing you need to see, that is it supposed to be a hybrid contract? So the main question rises, how would you decide that it is a hybrid contract? So I'll put it in very simple words, that when you say it is a hybrid contract, I can say there is a factor which changes the cash flows of the contract. Rather, I would say a factor changes means it varies them. So factor which changes the cash flow of the contract. I can put it in simple words, that is, if that factor was not there, if that factor was not there, cash flows would not vary. Cash flows would not vary. So I think taking the same example which I gave you got a purchase of a machine in a foreign currency. You got a purchase of a machine in a foreign currency. So I would say the cash flows are varying because of the exchange rate fluctuation. Had this contract not been in a foreign currency, but had it been in a functional currency, the cash flows would not vary. So वो कौन जिम्मेदार है जिसकी वजह से आपके cash flows fluctuate कर रहे हैं? The exchange rate fluctuation. So you need to identify the factor which makes the cash flows vary. And what is that factor going to be called as ED, embedded derivative? So at the first instance, what you need to do, identify that factor which leads to fluctuations of the cash flow. See that factor is one. If the factor is there, cash flow vary. If the factor is not there, cash flows will not vary. That is what is called the ED. So once you say that it is a hybrid contract, so I would put it like this: the answer is a yes or the answer is a no. So you say yes, it is a hybrid contract, or you say no, it's not a hybrid contract, then you can say the concept is not applicable. If you say that no, it's not a hybrid contract, I don't see any factor in this particular contract which is making the cash flow vary, there is no ED. In that case, finish. If you say a yes, then what do we need to do in this particular case? If you say a yes, I will say, number one, you do one thing, segregate. Number one, you do one thing, you segregate the host and the ED. You segregate the host and the embedded derivative. The host is called the non-derivative. It is non-derivative in nature. Segregate the host and the ED. The host is supposed to be the non-derivative portion of the contract. And you can see the ED is segregated, which is supposed to be the derivative portion. And then what you need to do, you go to step number 2. Then you go to the step number 2. Okay, now going to the step number 2, what do we do? Let's go to the step number 2. In terms of the step number 2, what we're going to do in this case, we will now say that once you said it is hybrid contract, now see, is the, or rather let's put it in 2 parts so that it becomes easy. We can say number A and number B. Is it an asset? So the first question you're going to put across is that is it an asset? Plus, is it within the scope? Is it within the scope of the standard? So underline within the scope of Ind AS 109. So you need to put across the 2 questions to yourself. And the 2 question is that is it an asset within the scope of the standard? Now, when you look at whether it's an asset within the scope of the standard, the answer is either a yes or the answer is either a no. Now let's get it very clear. When you say it is an asset within the scope, the answer is going to be yes, typically if it is a financial asset. And if you say that it is an asset, either it's not an asset, it is either a liability or it is an asset which is non-financial and not in the scope. So it could be a non-financial asset. So generally we can say that when you're saying that is it an asset, if it is a financial asset, it might be in the scope, yes. And if it is supposed to be, though you know financial assets which may not be in the scope. So it is a financial asset in the scope, but if it is non-financial, it is asset but not in the scope. It's a liability, it's not an asset. So when you say yes, it is a financial asset, then there is no need to segregate the ED. Then there is no need to segregate the ED in this case. Financial assets including ED not segregated. But if you say no, we will say, okay, let's go to the step number 3 and decide. We're not going to decide anything. We're going to say, okay, let's go to the step number 3 and decide. Now let's have a look in terms of the step number 3. Now have a look in terms of the step number 3, that once you decided it is hybrid, yes, it is not an asset, or maybe it is an asset, but not in the scope of the standard. Now we come to the step 3 and we need to evaluate. We need to evaluate 3 conditions. Now we need to evaluate the 3 conditions, and what you need to do, you need to meet all conditions to segregate the ED. If you want to segregate the ED, you got to meet all 3. You fail any one, ED not segregated. So let's put it out here that if you fail any one in this particular case, you fail any one condition is failed in this particular case, the entire hybrid instrument, the entire hybrid contract or the hybrid instrument is measured at FPTPL. The entire instrument is going to be measured at FVTPL. The entire instrument is measured at that case. In this case, ED is not segregated. The ED is not segregated in this particular case. So we need to consider that if you meet the conditions, I'll segregate, but if you fail any one of the conditions, ED is not segregated. The entire instrument is measured at FPTPL. So what are the conditions? Now let's have a look at the 3 conditions. Condition number 1. So I'm giving the conditions which you need to meet. The condition number 1 is EC and R. I call it as economic characteristic. We call it as economic characteristics and risk. Economic characteristics and risk. So we need to consider the economic characteristics and risk of the host and the ED are not closely related. The focus point is that they are not closely related. So you need to prove in this particular case. Now, how do you prove all that? We are not getting into all that. I'm just giving you the parameters. The economic characteristics and the risk of the host and the ED should not be related to each other. Maybe one has got a debt characteristic. Maybe the other has got equity characteristic. So if one has got a debt characteristic, another has got an equity characteristic, then it is not. If you remember that in terms of the compound financial instruments, if you remember, I gave you the concept when the optional instruments were there. We said it was an ED tested for a fixed test, and when it has got equity characteristics, we never used to segregate that. And I told you, I'll remind you of that particular point. So in a compound financial instruments, when the ED has got equity characteristics, we were not segregating, because we said it can be merged with the equity as a balancing figure. But when it was not having equity characteristics, but a debt characteristics, we were segregating, because the non-derivative was a debt which was non-derivative debt, and there was a derivative financial liability as well. So in this particular case, we were looking at the economic characteristics and risk. Then there is a condition number 2. The ED, if evaluated separately, so if I were to evaluate the ED on a separate basis, if the ED is evaluated separately, it should meet all 3 conditions. It should meet all 3 conditions of derivative. And we've already seen those 3 conditions of derivative, which I gave you earlier when we were doing the concept of derivative. That number 1, it gets its value derived from the underlying asset. Number 2, if there is no initial or negligible investment. And number 3, there is going to be a future settlement. So you need to prove that ED has got all the 3 conditions of derivative. And then number 3, you need to see that the entity has not designated. The entity has not designated to measure the hybrid instrument. to measure the hybrid instrument. So it is not designated to measure the hybrid instrument at FPTPL. So we need to ensure that the management is not decided that they're going to measure the hybrid instrument at FPTPL. If all these three conditions are met, then I would say it's time to segregate ED. And if any of these conditions fails, I will say no ED segregation, entire instrument taken at FPTPL. I know this is difficult to follow without too many examples being given, but I want to give you a larger picture. Now we're going to focus on the accounting, because in the exams also questions on accounting have come, but I want to still first give you the 3 steps in terms of deciding. Number 1, is it hybrid? Yes. Then number 2, you need to see that in this particular case, if it is hybrid, you got to apply your step number 2 and see that it is an asset within the scope. Don't segregate. If it is not an asset within the scope, segregate. But provided you meet these 3 conditions, then yes. Let's now take you to a practical illustration in terms of deciding how this is going to be segregated in this case. So I'm now going to take you to one of the illustrations which is given in the study material. Now let me tell you, in the study mat, you will see questions devoted to the fact of how the EC and Rs are evaluated. And they've also given more details on that for a better understanding. But I'm now coming to the accounting, the question on accounting in terms of this. Okay, I think this is an interesting question. I guess I am carrying a small little question as well. I've just added a small little question of my own. I'll just take you to that question. Yes. I guess let's have a look at question number 16, which came in the mock test papers in 2018. Now, watch this question carefully. You're going to get the entire accounting. This is going to be slightly technical, but once you understand the concept, it's going to be pretty easy indeed. Okay, so let me, I think, first read out the question, and then we're going to see how do we solve this particular question. It's a beautiful question indeed, but the concept should click to you. Once the concept clicks, then I think it is understood well. So I think let's begin with the reading of this question. I'm just going to first read the facts and then give you how the accounting is done. Watch the accounting carefully. If you get this accounting, then the entire ED accounting would be clear. Let's have a read. This is a question on the purchase contract, which is going to be settled in a foreign currency. So there is a purchase in foreign currency. Is there going to be fluctuations in the outflows due to fluctuations in exchange rate? Yes. So what is the factor which is leading to fluctuations in the cash flow? The exchange rate, that is the ED. It says on 1st April 17, X Limited, a company incorporated in India, enters into the contract to buy solar panels from Good Associates, a firm which is domiciled in UAE, for which delivery is due after 6 months on 30th September. So we entered into the contract today to buy a solar panel 6 months later. And it says the purchase price is $50 million. The functional currency of this company XYZ is supposed to be Indian rupee, and Good Associate is dirhams. So this should be company X, not XYZ. So company X, which is in India, has got a functional currency Indian rupee, and they're planning to buy the solar panels in dollar. The obligation is going to be settled in dollar, is evaluated. It's very clearly given. It is evaluated to be an ED, which is not closely related to the host purchase contract. He's already done the evaluations and he's telling you that yes, there is an ED and the EC and R are not closely related. I don't need to do anything. He has done all things. He's only telling me, please segregate it. And then I'm given the spot rate on 1st April. I'm given a 6 months forward rate on 1st April. And I'm given a spot rate on 30th September. So spot rates on 1st, spot rates on 30th September, and a forward rate on 1st April, which is applicable for the next 6 months. Analyze the contract and pass the necessary journal entry. Now, watch me carefully in terms of this accounting. So let's have a look at how we are going to do the accounting. Now, please see this very carefully. If this clicks, we're done. My advice is when you're doing the accounting for ED, do one thing. When you're doing the accounting for ED, do one thing. First, write down. First, write down the transaction. I'm going to write down the transaction. The transaction is to buy machine in dollars. Write down the transaction like this. It's a good deal in the exam that you write down the transaction. We are going to buy the machine in dollars. So I've written that the transaction is buy a machine in dollar. Now, I would say this is a host. This is a host. And I would say this is an ED because it is in a foreign currency. So now what I need to do for the purpose of accounting, I am going to segregate this into two components. See how I'm going to segregate this in terms of two components. Watch this carefully. How I'm going to segregate this in terms of two components. I will say I'll buy machine. I'll say I'll buy a machine. I'm going to buy the machine in INR. I'll pay the money in INR. So, but I'm going to pay in dollars. Yes. I'm going to pay in dollars, but I will assume that I'm going to pay in INR notional payment. So when I'm going to consider this INR, this is like a notional payment which I am considering. This is a notional payment in INR. I'm breaking the transaction in such a way. I'm breaking the transaction in such a way that there is no ED in this part. So when you say that I buy a machine, instead of saying in dollars, write down that I'll pay in INR. Though I'm not paying in INR, it is a notional payment. In order to match the notional payment, I will also create a notional receipt. In order to match and cancel the notional payment, I'm also going to create a notional receipt. I am not paying anything in INR, so I need to correspondingly cancel and create a notional receipt that I will receive INR. That I will receive INR. So what will happen? The notional payment is going to be set off against the notional receipt and cancel. So when you say that I'm going to receive INR, imagine a contract. Imagine a contract where you're going to actually receive INR. So in order to receive INR, what do you need to do? You need to basically sell dollars. You need to basically sell dollars. So now see what is happening. You're going to buy the machine and you're going to pay in terms of Indian rupees. To cancel, you're saying, let me consider a notional receipt. So for a notional receipt, what do you need to do? You will say, okay, I will sell dollars, then I will receive Indian rupees notionally. So we have created this as another contract. You can say this is supposed to be, you can say a host contract, and this is supposed to be a derivative which is created as a forward contract. This is a derivative and this is a host which is supposed to be a non-derivative. Sir, can you please come once again in terms of this thing? Let me, I think, explain this again in terms of things. Now let's consider this again out here. Now, what we're doing in terms of this is, we are saying, when you look at a transaction which has got a ED in between, there is a hybrid instrument. My piece of advice is you first write down the transaction. And what is the transaction in this case? That you're going to buy the machine. You're going to buy the machine in dollars. It's very clear that I'm going to pay $50 million to buy this machine. So when you say you're going to buy this machine in dollars, there is a hybrid contract. I want to segregate for accounting. I need to segregate for accounting that there is a non-derivative host and there is a derivative which is going to be a forward contract. I am not entering into any forward contract. Tell me. Let me make it very clear. I am not entering into any forward contract. This is only notionally created for accounting. So what we split in terms of things is, instead of saying that you buy the machine and pay in dollars, let's say that you buy the machine and pay in INR. Because the moment you say that you're going to buy the machine and pay in INR, the fluctuations due to exchange rate is gone. So the derivative is gone. So buying a machine and paying in INR creates a non-derivative contract. So this is a non-derivative host. Now, since you're creating a payment in INR, which is not there, I'm not going to pay in INR. It's a completely assumed notional payment in Indian rupee. So you need to correspondingly create that you're going to get receipt in terms of Indian rupee. So we say, okay, there is going to be receipt in INR and you're going to sell dollars in this case. So what we're going to do, we're going to do a separate accounting for buying the machine, and we're going to do a separate accounting for the forward contract. And this forward contract is something which is purely notional. We have not entered into any kind of forward contract as such. Now let's see what is the accounting going to be. Let's begin with the entries and let's see how we are going to pass the accounting. Now, I would say if I go with the dates, on 1st April 17, you entered into the contract. So we can say on 1st April 17. On 1st April 17, if I look at the forward contract, is the forward contract a derivative? Yes. There is no initial payment which is made, and the value depends upon the underlying asset, the movement of the exchange rates, and it is going to be settled at a future. The fair value of the contract at the inception is always zero. The fair value of a derivative contract at 0 point of time is always zero. If you square off a particular derivative contract at inception, it'll always be zero. So no entries will ever be done. No entries will ever be done at the time when the notional forward contract is being accounted for. Mind the words. Now, let's go to the further inputs and let's look at the situation on 30th September, 19. Now, in this particular case, I need to compare the exchange rates. So let's have a look in terms of the exchange rate movements which are given. I go back and see the exchange rate movements. I am given that the 6 months forward rate is 65 and the spot rate is 66. So we given the forward rate which we entered was 65 and the spot rate which is there on 30th September is 66. Now we need to understand in this particular case, is this a gain or is this a loss? Now let's understand. When you said you're going to sell dollars, that means you are going to sell dollars at what rate? You're going to sell dollars at the rate of 65. And to square off the transaction, what you're going to do, you're going to buy dollars at 66. If you remember, when I gave you the derivative accounting, I also gave you the concept of squaring off. In this particular case, we can say we entered that we're going to sell dollars at 65. So in order to square off the transaction, you need to buy at 66. So if you square off the transaction, we can say there is going to be a loss of 1 rupee a dollar. There is going to be a loss of 1 rupee a dollar because you'll buy at 65, sell at 65 and then buy it at 66 to net settle. So this loss is going to be recorded and captured in the form of the entry profit and loss debit, and you can create a derivative financial liability in the books of accounts. Because when you're doing a derivative accounting, it follows FVTPL. So any changes in the fair value of the instrument is going to be captured in the P&L. So this loss is debited to the P&L and the derivative financial liability is created. I guess this was to the extent of $50 million into one. So we get a 15 million INR. A 15 million INR derivative financial liability created. So what we have done, we've done the accounting for the derivative. We've done the accounting for the derivative, no entry at the inception, and then the fair value changes captured in the P&L. Now let's go on 30th September to buy the machine in terms of in terms of the forward contract. Now, when I am going to buy the machine, the entry which I'm going to put is machine account debit, PPE debit, and the bank gets a credit on the purchase of this machine. Now, when you're going to put this entry, this entry will be put on the ground as if you have entered into the forward contract. I have not entered into any forward contract as such. But I'm going to put this entry in such a way as if you have entered into the forward contract. So if you have entered into the forward contract, we can say you will be making a payment at the rate of 65. So if you're going to make a payment at the rate of 65, we can say this is going to be recorded at 50 million at the rate of 65, and we can see what is the total outflow. So 50 million at the forward rate is coming to 3250 in terms of INR. So what we have done, we've recorded the purchase of the machinery. I know what is going in your mind. I've recorded a purchase of the machinery as if I entered into a forward contract. But I have not entered into any forward contract as such. If I've not entered into any forward contract as such, now what I need to do in this particular case? Can this derivative FL be settled net in cash? No. I cannot settle this net in cash. Rather, let me do one thing. Instead of recording the bank, let me put it as creditors so that that's a little better. So in this particular case, this derivative financial liability cannot be settled in cash because I never entered into a forward contract. So what I'm going to do, in order to cancel this derivative financial liability, this derivative financial liability will be adjusted against the creditors, and that is to the extent of 50 million INR Indian rupee. Now, I want to tell you something which you should appreciate at this stage. Let me just consolidate the picture and tell you something very important, because you must be wondering what is this happening and why is it happening. I'll tell you. First, let's look at the procedure. So what I did at the first instance, I decided that let me do a split accounting. Let me split the transaction for ease of accounting. Why did we do that? You'll get the picture. I said you're going to buy the machine in dollar, but this dollar is going to result in fluctuations in cash flow. So let's assume that you're going to buy the machine in INR. So we'll write down the transaction in two parts: buying a machine in Indian rupees, which means no fluctuations, and this means there is no derivative in this. This is a payment in Indian rupee, which is notional. Because at the end of the day, I need to pay the money in terms of, you can say, dollars only. So in order to cancel the notional payment, you need to create a notional receipt in the books. So imagine a forward contract which you would have entered. Imagine a forward contract which you would have entered, which could have resulted in a notional receipt in terms of INR. And that would have been that you go and sell the dollars and you're going to get Indian rupee. So this is a notional forward contract, which is a derivative created to cancel the notional payments. There is a notional receipt which is created. Then what do we do after this? Account for the machine as if you entered a forward contract. Account for the derivative as if you've entered into the forward contract. So what we did, on 30th September, we did a squaring of the forward contract that you will sell dollars at this rate. So you will buy the dollars at this rate. So there is a loss, and the loss on the derivative contract is captured in the P&L. Though there is no forward contract entered as such. But this is completely a notional accounting where you're putting an entry as if there would have been a forward contract. It would have resulted in a loss of 1. So you put the entry P&L debit because derivatives are FPTPL accounted, and you record a derivative FL. Record the purchase of the machine as if you entered into the forward contract, and when you entered the machine to creditors with the forward contract, though there is no forward contract. Now, what do you do at the end? The derivative FL cannot be settled in cash. So the derivative FL is being adjusted against the creditors in this case. Now, watch me carefully in terms of the analysis. At the end of the day, if I did not enter into a forward contract, how much money am I going to pay to the creditors? The spot rate, which is there on 30th September. And my spot rate on 30th September is 66. So imagine if you're going to pay 66, just calculate this. You're going to pay 50 million to the creditors at the rate of 66. So the total money you're going to pay to the creditors is 3,300. C is the creditors recorded at 3250 plus another 50. Is it recorded at a total of 3,300? Because you never entered into the forward contract, so your liability is getting captured equal to the spot rate on 30th September itself. But what is happening in this particular case, the machine is getting captured at a forward rate. The machine is getting captured at a forward rate, and the excess, which is the exchange fluctuations, is indirectly getting debited to the P&L. So you can see the amount of foreign exchange fluctuation is not a part of the cost of the machine. Mind the words. The amount of foreign exchange gain or loss is not a part of the cost of the machine. If I don't do this accounting, you will end up putting an entry machine debit at 66 and the creditors credit at 66. But what is happening now, because of this notional accounting, the machine is getting recorded at 65, which is the rate which was predetermined at the inception. Any changes in the exchange rate is supposed to be just fluctuating the cash flows, and that exchange gain or loss is not a part of the cost of the machine, so that should not be allowed to be adjusted to the machine. It should be immediately taken to the P&L. Because if you allow the machine to be capitalized at 66, then in that particular case, capitalization at 66 means that the exchange loss is getting added to the asset, and then it'll enter the P&L slowly in the form of depreciations. And the standard setters decided that because the contract is in a foreign currency, let's say a company in this particular case would have bought this machine actually in terms of a functional currency, they would have capitalized only at 65. And the rest, which is supposed to be the exchange gain or loss, is purely an exchange gain loss. It should not get added to the asset, but it should get expensed in the P&L. I hope you got the essence in terms of why the embedded derivative is segregated in terms of the non-financial assets. So the company would create a notional forward contract, and in this particular case, since it's a notional forward contract, at the end of the day, you're going to make the adjustments in terms of the creditors. So your liability will stand at a spot rate, the machine will stand at a forward rate, and the difference between the forward and the spot rate enters the P&L on an immediate basis. I hope, friends, I made sense on that. Let me see any questions coming. Okay, I guess, okay, I think Nikhil tells me, so since I have a backlog to cover, I can't attend your live lectures, which I have regret. But sir, thank you for your amazing lectures. I just want to say that after watching your lectures, I can only say that they are synonym of quality. Oh my God, that means a lot. That means a lot, Nikhil, to me. I think you have actually made my day as well. As it is the last day on my financial instruments. And I think with that particular inputs, it really feels amazing. It really feels good. And of course, it gives you motivation enough to do further things, more improvements as well. Learning is a continuous process, and I think I keep looking into how things can be more made more easy, because I know there are certain topics which are really complicated, and to make those complicated things easy is also a big task indeed. So really thank you so much for your inputs on that. Right, friends, so I think that finishes the concept of ED as well. And finally, it finishes the entire ambit of financial instruments. Now, my piece of advice, friends, before we close this particular financial instruments, my advice is that since it's a very complicated topic, but at the same time, it is a very important topic from the examination point of view, I would say that now it's time that you do a full complete revision of this standard. Sit down and revise all the 10 classes we have spent on financial instruments, and trust me, you'll feel much more confident, you'll feel the clarity of thought is much, much more when you're going to revise it in a go. Because what happens, a few things discussed at a later stage. So when we were doing things at the inception, that connect was not there. So now once you're going to revise things in entirety, you're going to get the flow. And then simultaneously keep revising the questions from the study material as well. You'll definitely feel much more confident in terms of this entire section. So over to you, friends. If you've got any questions at this stage, the journey on financial instruments comes to an end on that. So over to you, friends, for any questions on your side. Otherwise, I think we are done for the day. So the entire journey we have carried on from business combinations to consolidation standards to financial instruments. I think I'm really thankful to the Institute for giving opportunity in terms of dealing with these wonderful topics. And it's been a wonderful journey with all of you. And if you've got queries, of course, on any of these complicated topics, you have the email. Please send your queries as well. And I'll be more than happy to address all those issues as well. And Prashant says, so how should we revise FR? Well, I would say that, once you've already made your notes, I think the best thing is that when you are going to practice now questions, do a revision of the standard in entirety and then do practice. Because when you were learning the standard, you would have already made your revisions in bits and parts. Now it is time that when you go to revise FR, pick up a particular standard, revise the entire standard, and then attack the questions. So that would be a good strategy. If you're comfortable, start with the tougher topics. And if you're not very comfortable, start with the easier topics. I think that's the simple game, because if you feel the intensity is too hard for the tough topics, get yourself conversant, revise the easier topics, do the asset related kind of standards, get your comfort zones, and then come to the, technical ones. But if you feel confident that yes, you can handle it, then go for the topics. That's a personal call. Bansha, sir, should we study educational material along with study module? I don't think so. That would be required, because many of the questions in the study mat also includes questions from the education material as well. So I think you may not make a separate reference to that. I think you can just concentrate on the study mat, do the revisionary test papers, of course, and look at the past examination questions. I think that should be enough. There are a lot of questions in the study mat itself. Every chapter has been supported very well with a lot of illustrations. And I think if you do that, it's enough, because after all, there is a limit up to which you're going to do things as well. And Viraj, so thank you for clearing concepts. Thank you. And you've explained financial instruments nicely. Thank you. Thank you so much, Viraj. That means a lot. And Mansha, thank you so much. You're an incredible teacher. Thank you, Mansha. That's really sweet of you. It's been, I think, the journey has been successful only because of the love and affection you've all shown. And it also brings me, a little moment in terms of that, I'm just going to imagine on Thursday, that I have a class at 6, but it's not going to be there. Anyway, but every good journeys have to come to an end as well. And Amita, you said, so you are raising the standard of a professor on another level, and this is hard to find. Thank you so much. Thank you, Amita. Thank you so much on that. That means a lot. That's really sweet. And I think these are memories which I'm going to cherish and on. So on that note, of course, I wish you all the best for your exams. Hope to see you all very soon in terms of using the prefix CA in front of your name. So see you as a proud chartered accountant very soon on this. And it's going to be very interesting. Once you become a CA, the journey starts to a next level as well. So this is your just a start in life. Once you become a qualified CA, it's going to be another levels as well. Yedu, sir, thank you so much for all your efforts. It really helped a lot. Without you, sir, it was easy learning. I really loved your teaching style. Thank you, Yedu. Thank you so much indeed. That's really sweet of you. And Shruti, sir, thank you, sir, for your detailed lecture. Thank you, Shruti, as well. I think it's really a very proud moment for me. I think teaching you all, and with such wonderful audience, कहते हैं ताली एक हाथ से नहीं बजती. जाते जाते एक शेर जरूर सुनाऊंगा आपको, because sometimes when it happens to be my last class, there is always a little शेर which comes, though it goes in Urdu, but I think I like to put it across. कौन किसके करीब होता है, कौन किसके करीब होता है, अपना अपना नसीब होता है, याद करता है जब अजीज कोई दर्द दिल के करीब होता है. So, on that note, friends, thank you very much indeed. Thank you once again and wish you all the best. On that note, friends, I take your leave from you. Best of luck for your exams. Thank you. Bye bye and take care.